Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, morning.
Hi, good morning. Is love in the air again? No, let me not be tongue-in-cheek, but I think the biggest headline came, this was on Saturday morning, right, when we had a statement from the US president sounding very different after months. So let's see, starting off with hope.
Well, did you see the US Open final, Prashant, last night?
I didn't see a single
Alcaraz.
game, Nigel.
Oh, no. All right.
What happened?
I saw a bit of it.
11:30.
11:30.
Wake up till
Yeah.
4:30. It just doesn't work.
By the way, it got delayed because President Trump had to make his presence felt out there.
I saw something that he's
and
late.
the audience, you know, they didn't hold back. You know, it looked like there were only Democrats in the stadium out there.
But New York, right, Nigel?
Yeah.
Finals in New York.
Yeah,
so New York
yeah.
is New York.
A couple of reasons, security reasons, it got delayed, the start was delayed, so a lot of booze out there, but we've got markets to contend with, so let's get straight.
We only have one market to contend with because rupee markets are shut.
Shut, yes.
And I think maybe that affects volumes as well, a little bit at the margin. We'll see. I mean, that's number one. Rupee markets, money markets are shut, so you don't have any cues from there. But it is very much equities which are open. Now, I'll start with what's top of mind, right? President Trump called Prime Minister Modi a great Prime Minister and insisted that ties are special. I think this is what is being talked about, what this means. Is this an overture? How much should one read into this? Is this thawing of relations, etc., etc.? Why don't we listen into President Trump himself?
I always will. I'll always be friends with Modi. He's great. Prime Minister, he's great. I'll always be friends, but I just don't like what he's doing at this particular moment. But India and the United States have a special relationship. There's nothing to worry about.
So that was President Trump. And then the reason it was seen as a thawing of relations is because Prime Minister Modi responded and responded warmly. That is the exact quote tweet which essentially came from Prime Minister Modi. Deeply appreciate and fully reciprocate President Trump's sentiments and positive assessment of our ties. India and the US have a very positive and forward-looking, comprehensive and global strategic partnership. And I thought that got people excited, and why not? I think, and that's absolutely correct. It's only factual without reading too much into it. This is President Trump's comments come right after him in a couple of days. 48 hours after you got that social media post from the president himself saying that, well, you know, too bad we've lost India to China. And then you got this, and then Prime Minister Modi responding. So a fair bit of chatter, a fair bit of speculation whether this was, this is thawing of relations. Some even going to the extent of saying whether this was kind of choreographed backstage and then, you know, we saw what we saw on social media. And whether, you know, things are working overtime. And this is the first step towards normalizing some of course, what has gone wrong over the last 1.5 odd months or so. So I think it's very significant for the market as well because, you know, these 50% tariffs, the additional 25% tariffs have been the big hanging sword. I remember, 3-4 days back, you had, that tweet from President Trump and we said, well, you know, it was looking less confrontational. This is 3 days back, middle of last week, early last week. So looks like, at least, I mean, you know, the language which was being used, which was extremely sharp, etc., that's starting to soften a little bit. But we'll have to see. At the end of the day, you know, platitudes will matter only so much. You need policy action, firm policy action. And the first, of course, is to take this 25%, this additional 25% off, and then work down the rest of the 25% as well. So that's something which we will continue to get you views on. Now, just to go to the US, you had a solid miss on US jobs data. A consensus number was 75,000 jobs, 22,000 were added, and it basically reinforced that on the 17th of September, a 25 basis point cut is a given. Could it be 50? There is some small pricing of even 50 basis points on the 17th of September, but 25 now seems to be a given. S&P was down about 1/3%. We ended mixed. The 10-year was down 7 basis points. The dollar index lost about 0.6% to about 97.77. So that is the overall picture in terms of both equity and macro markets and how they ended at. By the way, the dollar index, and we'll put that chart up later, it's an extremely significant trend line which rises up all the way from the global financial crisis, 2008, 2009. And we're exactly at that support at where we closed on Friday. Positioning, and this is important as well. So this is the second largest short positioning from FIIs and index futures ever. The first was on the 24th of February, about 2 lakh contracts. It's about 1.9 lakh contracts now. So extreme shorts, it sometimes acts like a coil and you go the other way. In any case, I mean, if you're wondering whether what we heard from Prime Minister Modi and President Trump will lead to the market doing well, I think mostly it's gone on the back of maybe a little bit of short covering, a little bit of lightening of shots from foreign investors. So I think this is a significant data point. By itself, it doesn't tell you very much, but accompanied by other news flow around it, I think becomes important to take note of. I'll just tie in the levels. Nifty, of course, on Friday managed to close above the 20-day moving average for the second day in a row. And until the low of 24,522 is not broken, the pullback can continue. On the way up, 980 to 25,000 is significant resistance zone for the Nifty. For the Nifty Bank, we saw a positive weekly close. That is last week. Here, supports out of the recent low of 53,561 and resistance is at the retracement levels 38 and 50, which is 54,490 and 54,777. So those are levels for the Nifty Bank as well. GIFT Nifty, I think, indicating a higher start this morning. Nigel is standing by with what the F&O stats are telling us. Nigel, over to you.
Well, the bulls will be eyeing a bold start to the week. And I'll give you 3 big reasons. The Nifty gold ratio, well, that is indicating that we're at extreme levels. That's point number 1. There is hope that maybe we get some kind of a breakthrough with regard to the sound bites that we're seeing on India as well as the United States. And point number 3 is the FIs, well, they're positioning in the cash market in terms of holding is the lowest we've seen in 13 years. And in the, in the F&O market or the index futures, it is net short. Let's take those points point by point. If you look at the Nifty gold ratio, that's come down to around 2.3. History suggests that, in fact, around these levels, we do see that the Nifty, either the Nifty bounces back or you have gold that cools off. So that's going to be, an important data point that we will be eyeing. The positive commentary from both President Trump as well as, the sound bites that we got from Mr. Modi as well as his team, that as well as positive. Let's get to the third point, which is the short positioning. The short positioning, well, they added close to 1,500 short contracts. In percentage terms, this is the highest short positioning we've ever seen. Keep in mind, when there were 2 lakh contracts, the short positioning was around 85%. So if you look at it in percentage terms, this is the important data point. 92.6% on the short side, that's an extreme level. And I'll tell you what, in the last 5 sessions or so, the FI net short positions have moved up by close to 10%. However, they're not getting follow through on the short side because the Nifty hasn't fallen. So that chart as well will come up for you. In absolute terms, you have around 1.9 lakh contracts on the short side. And in fact, the Nifty is more or less holding its ground. Well, moving to, the options data then, you have the 24,700 call, that had a fair bit of open risk build up, 24,800 call, good amount of open risk build up. And on the downside, the 24,650 put, a fair bit of open risk build up, which brings us to the levels. Last week's high is very, very important because, you have this high, 24,981. September 4th, that's the important high that we saw there. So that becomes a near-term resistance level. Going by the options data, 24,600, that's a support level. Well, moving to the Nifty Bank then, that was showing signs that it wants to give up its recent underperformance. However, the 20 DMA, well, that becomes the first resistance mark that you're looking at on the Nifty Bank. 2 stocks that I'm looking at from the broad markets, Amber Enterprises, they've gone ahead and they've raised 1,200 crores from one of their subsidiaries. Remember, when they acquired the subsidiary, it was doing only 300 crores of revenues. Last year, they did 2,100 crores. And now the fundraise, could say that the value of this particular subsidiary itself is 12,000 crores for a company that has market cap of 26,000 crores. So I'll keep an eye out on that one. The second one is Suntech, one of those big underperformers from the real estate basket, pumping in close to 500 crores via preference issue, promoter entity, bulk of that, and some renowned investors as well. So we'll keep an eye out on both these 2 names. Back to you.
Okay, all right. So we'll keep an eye out on some of these stocks. By the way, in Asia this morning, there's an important piece of news. There's political change happening in Japan, and the market is reacting quite a bit to this. We saw the resignation of the present Prime Minister, Ishiba, over the weekend. And the reason why the Japanese market is so excited is that one of the incumbents who could be a potential leader or successor, Takaichi Sane, he is seen as a protege of the former Prime Minister, Mr. Shinzo Abe, and he's very pro-growth, pro-deregulation, doesn't like interest rates going higher, which explains why there's a big rally in Japan this morning. Other markets are also not doing too bad at all. I mean, pretty okay. Just keep an eye out on crude. Yeah, that's what we've been talking about. So there's a lot of political uncertainty in Japan right now. The yen is weaker. But if this gentleman, Mr. Takaichi Sane, comes into power, then the market feels that the pace at which or the expectation of the BOJ rate hikes, that will change, which is why the equity market in Japan is higher this morning. Just one more word, keep an eye out on oil as well because of the OPEC Plus meeting that happened over the weekend. They are, increasing output, but not the pace at which they're increasing output is reducing. So the market's feeling maybe a little tighter supplies, and therefore oil is also higher this morning. Well, let's take the conversation forward. We have Taimur Beg, Managing Director and Chief Economist at DBS Group Research with us. Taimur, great to have you in our studios this morning. What a pleasant surprise.
Good morning. Lovely to be here.
Wonderful. So much going on, so much to discuss, including, of course, what your interpretation is of the US President's statement that he made. Tell us that, but also tell us this, that India has done a lot in trying to fortify our economy here, in face of those 50% tariffs. So whether it's GST, whether it's a couple of other measures, do you think, numerically at least, these local measures are enough to offset 50%? Maybe 50% goes because of what we've heard. We don't know.
Right. I will compartmentalize the two issues. I think there was a secular need for some growth supportive measures anyway, independent of tariff, Trump, and everything. So when we look at sort of the loan deposit ratios evolution over the last 12 months, when we look at the capital market environment, extremely buoyant 23, 24, but from late 24 to now, it's not been that great. So to some extent, the three-pronged measures that we've seen, income tax cut, the RBI cuts, and now the GST rationalization, are great measures independent of what's happening on the external side. India can control what's happening on the external side. Trump may change his mind tomorrow, make things better or worse. The only thing we can do is work on the domestic demand side and the non-US aspects, doing deals with Europe, and Singapore's prime minister was in town doing deals with Singapore and so on. So from that perspective, I think one has to sort of keep a eye on the prize type mentality that, we want domestic demand, we want manufacturing investment. We do what we can't control what the gentleman in the White House is going to do.
But is it enough? Is it an offset? I mean, just purely when you do the math in terms of the economic impact, the GST cuts coupled with the kind of monetary easing we've had, is it enough to offset this, roughly 1 percentage point hit because of the tariffs?
Impossible to answer. Absolutely impossible to answer because we don't know the duration and the magnitude of tariffs. We have other uncertainty from semiconductor and pharmaceutical. So it is helpful. Is it enough? Only hindsight and Trump's tweets will tell.
By the way, Taimur is got you said a lot is going on, but I think he's got a freer kind of day today, Taimur.
Yeah, I was surprised by the fact that there's not much going on today. Yes.
Because money markets are shut.
That's right.
Yeah. So yeah, I mean, you can talk to us.
Happy to be here.
Taimur, President Trump hailing Prime Minister Modi and Prime Minister Modi reciprocating, do you think this warmth between leaders will translate into policy?
I think that posturing and policy are interrelated these days, especially given the way Trump operates. If he wakes up in the morning and he's feeling good about himself, that will translate into some policy action, but it is transient. That's the problem. The U.S.'s biggest casualty, in my view, in the last 8 months has been the lack of reliability. Tomorrow, we might celebrate some exchange of warm words between the two leaders. That doesn't mean that it'll be like that a week from now. That uncertainty is paralyzing. When we think about the investment environment in the 12 to 24-month horizon with the U.S. demand in mind, it is exceptionally uncertain because nothing that happens tomorrow tells us what's going to happen day after tomorrow. This is, I think, is the biggest casualty, and this is going to hurt investments related to the U.S. It might solidify other investments outside the U.S. We use the acronym TOTUS, trade outside the U.S. 89% of global trade is outside. That, I think, becomes more reliable. With the U.S., that overhang is going to be debilitating.
Today you also have the virtual BRICS meeting.
That's right.
Right, which is, I don't think that's gotten too much attention, but what's your sense? I mean, it's going to be significant or, it's like, everyone is hedging their bets to see what happens next.
Right.
So,
So it's odd, right? On one hand, the narrative from the U.S. is they only care about the U.S. They don't care about the rest of the world. On the other hand, they do care about every single other alliance that is being made because they see it as a threat to the U.S. So if the BRICS talk about some currency, tariff on them if they do that. Yeah. If they're going to have a meeting, to your point, better keep it low-key because you don't want Mr. Trump to start tweeting about it. Yeah. So the U.S. is sort of inside, outside. You know, the one storyline that we completely miss out because we are so distracted by what's happening in South Asia, East Asia, and the U.S. is what's happening in Central America. U.S. Navy ships on the waters of Venezuela. There might be other countries where the U.S. might want to institute regime change. So on one hand, the U.S. only talks about fortifying its borders. On the other hand, it's really, really pushing its force outside all over the world, from the Middle East to Central America. This makes, again, life very difficult for government officials who have sort of built an edifice of trade and commerce around U.S. reliability. So that slipping and that inside out is causing a lot of uncertainty. Biggest manifestation of that is, of course, in gold prices. More so than rates, FX, equities, it's the gold price that shows how uncertain we are about the days ahead.
Well, you know, Taimur, good to see you in the studio, and put it on a lighter note. You know, it's like in high school. You don't want to go on a date with me, but you don't want me to go with the others as well, right? So just on the lighter note. But let's take a couple of those aspects forward. One is on gold. You know, the kind of move that we're seeing in gold has been phenomenal. It's done better than most of the stocks as well. And that's one data point that we're tracking from an equity market perspective as well. Point number one, so where do you see that headed? And the dollar index. You know, when Trump, came to office, we saw it dancing away to around 110. Now, from an emerging market standpoint, it's extremely important. It's holding around that 97, 98. Do you see more weakness on the dollar index, or do you think from here on we see a bit of a rebound?
Nigel, with that jacket, I'm sure there were lots of dates, so that's not an issue. But, okay, so on the gold side, historic relationship between real interest rate and gold is very straightforward. When real interest rates are high, gold prices fall. When they're low, gold prices go up. With that relationship, which over a 20-year horizon is a very strong relationship, gold would be at $1,600, not at $3,600. That difference tells you how much geopolitical uncertainty is being embedded.
Right.
Whether it is a central bank balance sheet operation or individuals in China, in India, people are looking at gold increasingly as a source of hedge. So that, to me, keeps gold demand elevated regardless of the Fed does.
Okay.
Typically, Fed cutting rates is a bullish sign for gold. I think that is now breaking down.
Yeah,
I think
that correlation is broken a bit.
And it's really about the uncertainty. And I think as long as the gentleman we have in the White House stays, that uncertainty premium would be reflected very strongly on gold prices.
Before you answer the point on the dollar index, what are you expecting the Fed to do?
They'll cut, and they'll probably cut again. They probably would have cut without Trump, shouting at them, and they probably would have cut even without all these uncertainty with Governor Cook and so on, because I think the Fed's discussion tilt is going toward labor market as opposed to inflation.
Okay.
They will worry about inflation, I think, down the road if indeed tariff-induced inflation becomes big.
Yeah.
But for the time being, they'll just focus on the labor market. On the currency side,
Yeah.
big bifurcation. Against developed markets, the US dollar has weakened substantially. In emerging markets, it's been very heterogeneous. So you look at a country like India, weakness pressure against the US,
Yes.
but when you look at overall DXY, substantial weakness. I think that it sort of again tells you that the dollar is sort of pushing out its power in very asymmetrical manner. Countries that are subject to a huge amount of tariff-related issues, they will see their currencies weaken a bit. Currencies that can sort of stand up a bit to the US are holding up against the dollar. The biggest casualty in all this is the euro. I don't think the Europeans want a massively strong euro, but if you look at rupee's behavior against the euro, the way it has weakened, and the euro strengthened against the dollar, with all this tariff-related cross-current, question about competitiveness, issues related to China, everything gets even more complicated by the euro's sharp climb.
Very quickly, Taimur, one last question in terms of just figuring out flows. And this hurts a lot because the numbers are so stark in comparison. Nifty is flat for the year. I just checked the numbers again. Korea is up 25% last year. Mainland China, 40%. Hong Kong, 50% equity market. Do you see anything changing in those patterns? Or is this very durable growth that's coming back to maybe a China or South Korea? Because that's where the money's been going. So just want to figure out if there's any change in the near future.
I think that was more of a relative valuation play.
Exactly.
India had become expensive. The US is very expensive.
Yes.
I think I've come to the show in the past and talked about the fact that the relative valuation certainly meant that even US money managers felt deploying some risk to East Asia, in spite of all the tariff mayhem, was worth it, and it's paid off very, very handsomely. In the case of India, I don't think we should look at it as a 12-month horizon. Let's look at it as a 60-month horizon. The strength in India's capital markets has created very interesting secular tailwinds for deal-making going forward. When you think about Indian companies with 20-plus PE, they can find it very worthwhile to deploy that valuation to pick up companies in Korea, in Japan. So that outward investment, which we never really saw in the past, is going to help India because that brings in tech. Tech transfer. So I wouldn't sort of look at the ongoing weakness as a major source of worry. It's a bigger stock issue. The stock issue is quite positive.
All right, Taimur, have a wonderful day, a free day, and enjoy yourself in the city of Bombay.
With pleasure.
Thanks very much for dropping
Thank you very much.
Thank you.
Thank you.
Well, I think we're going to take a quick commercial break here. But before we do that, let me quickly run you through what's lined up here on the program. So at 8:35, you'll hear from Nikhil Narendran, partner TMT Tri-Legal, and Ganesh Natarajan, chairman at GTT Data Solutions. We'll talk about, the big fear on Friday, right? The IT index sold off heavily. Services on Trump's radar. How plausible is that? And should one really be worried is the question. 9 o'clock, Godrej Consumer Management comes on to talk about the GST bump that they expect. 9:20, Kenneth Andrade of Old Bridge Mutual Fund will talk to us about market views. 9:35, Uno Minda, stocks done extremely well. Impact of GST cut on auto parts. Vishal Goyal of UBS will be talking to us about financials at 9:40 towards the end. Lata speaks with KVS Manian on the federal bank's outlook for itself going forward.
All right, time to slip into a quick break. We've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. We're looking at auto stocks, Samvardhana Motherson, Amber Enterprises, you have Max Estates, Suntech Realty, and Time Techno Plus. All of them will be reacting to positive news flow. But on the flip side, Vedanta, Oro Pharma, Dr. Reddy's, and SpiceJet will be reacting to negative news flow.
Welcome back. Asian markets have been holding up. Wall Street had a negative close, but we have the US president finally, showing a bit of, not a climb down, but some softness in those comments. And will that be enough to give a leg up to the bulls again? They did show some sign of strength on Friday itself. Let's pull up the implied open. It's been suggesting a positive start, 34, 35 points higher, so not looking bad at all. Of course, our list of stocks is ready to prep you up for what you need to watch out for on Monday morning. So let's straight away get to the team. Guys, morning to all of you. Lots of stocks to discuss, but so let's start with those auto companies. I don't think anyone's waiting till the 22nd, right? Many of them have already announced price cuts.
So as of now, three major companies have announced price revisions, and those are Tata Motors, Mahindra and Hyundai. So while Mahindra and Mahindra was the first one to announce the price cut, and its price revision already has been implemented effective September 6. And other two companies, Tata Motors and Hyundai, have announced price revision that would be effective September of 2022 as per the GST announcements. Now, apart from these, so this would be positive considering that now all these new buyers can use the reduced rates for if they want to buy new cars or new bus or new trucks. But apart from these auto companies, one stock that might be in focus is Samvardhana Motherson, because over the weekend, company has announced or unveiled its plan for FY30, and it's looking very aggressive. So on revenue front, gross revenue is seen at $108 billion versus $25.7 billion that company reported in FY25. And now it's, if you imply, that's almost 33% revenue CAGR over the same period. Also on ROCE front, it says it's going to deliver 40% growth. And one important part that the company has added, that no company or no country will contribute more than 10% of its total revenue by FY30, and also will maintain dividend payout of 40%. And up to 75% of incremental revenue that company is expecting would come from new acquisition that would be from both auto and non-auto business. And lastly, on impact of tariff, companies say that there is no material impact from the US tariff announced so far.
All right, thanks a lot for that, Sir. Well, sources tell my colleague Ritu that Vedanta has emerged as the top bidder for JP Associates with a total offer of around 17,000 crores. I'll tell you what, the street will not like this unnecessary aggression when they have enough on their plate. Nuvama, they put out a few points why they don't like this. They say that they consider this event negative for minority shareholders. They are unconvinced by the rationale to acquire the group of assets. They're also getting into an unrelated business when the priority should be deleveraging. That's what Nuvama is saying. And in the demerged entity, this asset could be housed under Vedanta, where funding the entire 17,000 crores itself could be a bit of a challenge. And finally, they say that, culmination of the transaction is likely to restrict any kind of re-rating in the stock. So the short point is the street will not like this aggression, this diversification, and they would have preferred if Vedanta would have rather just focused on what they have on their plate. But we'll have to see how this deal goes. It's not a closure, but it's a step in that direction. So the street will take it negatively. Let's go across to Ekta. She's here to tell us about Dr. Reddy's and Auto Pharma. Hi, Ekta. Morning.
Morning. Well, I'll start with Aurobindo, which is in focus because the US FDA has inspected their Unit 12, which basically manufactures oral solids and injectables. They've received 8 observations. The company says all observations are procedural. Dr. Reddy's, US FDA completed an inspection of their API facility in the UK and was issued 7 observations. So I expect both these stocks to probably be in the red on the back of these 2 particular inspections because of the number of the observations being large.
Igor, thank you very much for that. Well, Amber Enterprises, significant news flow there, and SpiceJet also in focus. Winnie's got details. Winnie, good morning.
Hi, good morning. So Amber Enterprises, positive news coming in here as one of the subsidiaries, that is Ilgin Electronics, has announced that they have secured 1,200 crores as funding, and this is strategic funding. Now, who have they raised this money from? This is from KISS Capital. They've raised 1,100 crores, and the other 100 crores has been raised from Incred Growth Partners Fund. This is going to be through compulsory convertible preferential shares. Now, what will help, what is the need for this fund? One, they'll be using it for organic as well as inorganic expansion. And this is mainly going to be in the EMS side and the segments of the company to grow furthermore. And positive and bullish commentary even coming in from the management on that front. So they want to focus more on expanding further in the EMS sector. The next one, we have SpiceJet. Now, negative or red is what we're expecting here. Why? Q1 numbers, subdued quarter coming in for the company. Revenues down 35%. The company has slipped into a loss versus a profit last year, and EBITDA is at just 12.3 crores versus 283 crores last year. So down almost more than 90%. Yields, they managed to hold on to around 6%. Rupees 6 was the yield in Q1 FY26 versus last year 5.9%. Load factor, that has come off as well. Now, obviously, if you look at cost X of fuel, that has seen a sharp increase of around 31%. So that is an impact that comes in on overall the performance. Other than that, in terms of the available seat per kilometer, that's fallen down by 28% as well due to the operational fleet reduction that one has seen coming in. And obviously, there seems like a delay that is coming in this operational fleet expansion, which they're planned as well. So that is something that we'll be watching out for, but red expected for SpiceJet today.
Okay, all right, Vinny, thank you very much for that. Let's go across to Sonal. She's watching out for a few of the other stocks in news as well. Sonal.
Well, 2 realty stocks on my radar. Let me start first up with Sunteck Realty because they have issued 1.17 crore convertible warrants. This will be converted into equity shares amounting to around 500 crore rupees. The stock price or the issue price here is 425 rupees a share, which is lower than the current market price. This will be allocated to promoter and promoter group. For Max Estates, they are looking at foray into Gurugram. They have secured developmental rights of 7.25 acre land parcel, which will have a potential of 1.3 million square feet, and gross development value will be more than 3,000 crore rupees according to the company. And the outlay for this transaction is around 534 crore rupees. The launch pipeline with this will be more than 17,000 crore rupees according to the company. Last, we have Time Technoplast because it has gotten into a strategic agreement. It's an MOU they have signed with Ebullient Packaging Private Limited. They will be acquiring 74% stake in that company. This is valued at 200 crore rupees. Also allows the company entry into packaging business strategically. So these are some of the stocks which are on my radar today.
Okay, all right, Sonal, thanks a lot for that. We'll keep an eye out on all those stocks. Here's a quick recap of all the top stocks that we're tracking, the ones with positive news flow. They include some of them are Motherson, Amber Enterprises, Max Estates, auto stocks as well right on top. You have Sunteck Realty as well as Time Techno that will be reacting to positive news flow. Flip side, Vedanta, Auto Pharma, Dr. Reddy's, SpiceJet react to negative news flow. That's about the equity market action and stocks we're looking at. Let's hop across to Manisha, who's standing by to tell us what's transpiring in the commodities market.
Thank you for that, Nigel. I'll start with the crude oil prices, where we are looking at OPEC Plus meeting that was over the weekend, where the OPEC Plus has yet again increased production, but at a modest pace. In the months of June and July, we saw OPEC increase it by 400,000 barrels. August, September saw 550,000 barrels. But for the month of October, it's just about 137,000 barrels per day. So that is what has led to markets increasing there. Apart from the OPEC Plus meeting, it also has been about the U.S. non-farm payroll data on Friday, and the markets have reacted to that. After the data, we saw near all-time highs for the gold prices. It has hit a record high of $3,600 an ounce now. The traders are now assigning between 95 to 98% of a chance of a 25 basis point rate cut for the month of September. Remember, China has continued to buy gold for a 10th straight month in the month of August for its forex reserves, so that has been supportive as well. You also have silver trading at a 14-year high, copper prices at a 1-month high, and the soft commodities also seem to be doing quite well. So whether it's coffee, rubber, all of that trading in the positive.
All right, Manisha, thank you very much for that. So that is the commodities picture as things stand right now. So more later. What are the top brokerage calls of the day? Sudarshan is back with us with exactly that. So good morning.
Good morning, Prashant. So first one is Morgan Stanley has come out with a note on metals. It has upgraded most of the stocks from steel pack, upgraded JSW to overweight and target price is 1300, upgraded Tata Steel to overweight, target price here is 200, upgraded SAIL to equal weight and target is 140, and maintains equal weight on JSPL and target is raised to 1150 per share. It says it has turned constructive on steel spreads expansion and expects domestic steel prices to expand as demand is expected to improve going forward. Also, China anti-involution theme is gaining traction as per Morgan Stanley, and global macro factors are also turning favorable. And on the back of these, it has raised steel price estimates by 3% each for both FY27 and 28. Next one is Swiggy. Nomura has initiated coverage with a buy call and target is 550, initiating an upside of almost 25% from current levels. It says food delivery business is on a steady profitability path and is a key cash generator for the company. As for the quick commerce is concerned, it remains the main challenger, but profitability is likely to improve as well going forward, and it remains well funded for scaling quick commerce further, and risk of dilution remains very low.
All right. So thank you very much for that. So keep an eye out on this entire space. By the way, the metals index did very well last week, was up 5% Friday to Friday. And there is this Morgan call now coming with an upgrade to their entire space. More later.
I was quite happy looking at that note because we mentioned most of the points last week.
Yeah.
So, interesting.
Early and right. Well, we'll take a quick commercial break here. Dharmesh Kant of Chola Securities will be with us on the other side for some fundamental stock conversation. We'll discuss metals and some of the other stocks as well. Stay tuned.
Welcome back. Hope you're having a good morning. Well, we have Dharmesh Kant, Head Research, Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Good to see you, Ben. Well, let's talk about Vedanta. Source-based information indicates from my colleague Ritu. She says that, they could possibly be the winner for JP's assets. Now, the bid could be around 17,000 crores, but if you, back calculate it, it could be work out to around 12,500 crores or thereabouts. I think the street will not really focus on that. They'll be saying, why this unnecessary diversification? And that's what most brokerages are writing about. The stock, irrespective, is very, very attractive, at around 5 times, less than 5 times EV on EBITDA. They have a demerger in the works as well. How would you view this, this move by the company?
Good morning, Nigel. I mean, it's again a negative move to our mind by the company, because if you look at all the business verticals which Vedanta would be acquiring through Jayaprakash Associate, if the deal comes through, are new verticals to the business. They don't have expertise in any of the verticals going by the earlier, business forays, and this would be in addition to the already 5 verticals they are having, and they are talking about demerging of all the verticals, and then again 3-4 more verticals added to that, 7-8 business verticals to take care of. Secondly, what is very important is there's already a huge debt in the books of the Vedanta. It's more than 2.2 times debt to equity ratio, and the cash flow management which they have been doing, I mean, dividends are being paid out handsomely, more than 100% kind of a dividend payout ratio. So dividend goes back to your home, it stays there. But as far as the debt and the interest component is there, it stays in the balance sheet. It's a cyclical business. Commodity in a downturn, it hurts the P&L and the balance sheet quite aggressively. So outlook out there to how to reduce the debt. In fact, through this acquisition, I think they would be adding more debt on the balance sheet. So net though valuations look pretty attractive, nice cash flow, nice margins, and you are going into a metal upswing. And then this kind of a move will certainly have, market participants have their own doubts. I think there would be a minor reaction on the stock price. It will not be an aggressive one till the time it comes through. But the upside which was to be captured in this metal upswing is likely to be missed by Vedanta Limited.
Nigel, if you remember, a couple of days back we were talking about Vedanta, right? There's always something.
Yeah, always something. Always something.
A lot of value, but somehow it just doesn't, you can't quite grasp it.
But the important point is, let's pull up Vedanta 1 year chart, pull up the Nifty as well 1 year chart. We'll say that it's not moved. That was the point we're talking about, right? Yeah. But actually the dividend paid is 55 rupees, which, which gets a little bit covered in it. But this is the point, the street doesn't know what the promoter is going to do next. And clearly the street will not like this.
No, just look at the share price. I think it's at the same level where it was 8 years ago. So a lot of value, cash flow, no problem. Everything is there. It's just that, you got to have promoter intent to create value, which we will see. And we'll probably ask Mr. Anil Agarwal if we get the opportunity, what's on his mind in that sense, right? With this Jayaprakash diversification, completely different line of businesses, Dharmesh also pointed out. Dharmesh, President Trump, Prime Minister Modi, sort of back and forth indicates a little bit of thawing of the soured relationship. I don't know how much of it will show up in the markets, maybe because FIRs are short big time. People perhaps lighten up because it's a big event whenever that happens, and we may suddenly wake up to something dramatic on the positive side. But how to play it? Do you think it'll show up in the IT services space, maybe a little bit more as compared to the others? Because that is a space which sold off on Friday as well on fears of this on a tax on services kind of thing, which was fake. We highlighted that on Friday. What's your sense, Dharmesh?
Yeah, good morning, Prashant. Very likely, I think now the rhetorics and how the comments are being made by President Trump, it looks like he is willing to negotiate and come down to the terms with India. Only thing is he has taken such a big stand. How to come back immediately is a point in contention, and slowly and gradually, I think things are likely to shape up in favor of India. So you are very right. Any day you can wake up with a very good news, which can be a good propeller to the markets. How to play this out? I think one is the auto ancillary space, which has been, negatively impacted through this move. So that will come into a big time play. Textiles is another segment where you can see a very good quick moves on the stock prices if anything positive comes out through. And IT to a large extent, yes, because it's very likely that interest rate cut is coming in this September policy of FOMC. So that would be sentimentally, positive. It's a tactical trading kind of a play which we can, set in as of now, going into the overall scheme of environment in which the market is operating. But on IT space specifically, we are not very constructive from, long-term perspective.
Okay, and then of course you have to, even if you're looking at a tactical play, you have to be able to navigate and do swift trades, given that the news flow is so choppy from the US. Dharmesh, we'll have more questions for you in just a bit, but since we're talking about IT, let's bring in two subject matter experts as well. There's been a fair amount of growing concern and some reports, some social media posts as well, indicating that perhaps the US could be thinking of imposing tariffs on services that are coming from India as well, including, of course, IT services. Now, this, of course, could be a massive, massive move for India. Not just this, there is a new bill that has been introduced in the US. It's called the Hire Bill, halting international relocation of employment. And this bill is talking about a 25% tax on any payments which are being made to Indian vendors for the services that they're rendering to US companies. Now, is this significant? Should one be worried about this? Well, let's ask Nikhil Narendran, partner at TMT Trilegal, as well as Ganesh Natarajan, chairman at GTT Data Solutions. Gentlemen, thank you so much for joining in. Let's actually, the good thing is that we have that statement from the US president, right? Otherwise, this news of a new potential bill being introduced in the Senate, it could have made the market very, very nervous. Nikhil, let me open with you. I don't know if you've seen the details of this bill. It talks about several penalties, penal positions as well. But these bills, such bills have been introduced in the past as well. Should one be worried?
Look, I think in the current scheme of things and the way in which rhetoric is driving actual decision making, I think we should be cautious at this point of time, because we have seen in the past several instances where similar moves were proposed, but it did not really materialize. But given the current scenario, it's very difficult to say one way or the other. Having said that, there are a few things that we need to keep in mind here. The whole WTO ecosystem, which currently has a moratorium on taxation of digital services, is about to be relooked at in March of 2026, which means that generally when you provide services online, for instance, your services that you subscribe from Microsoft and other companies, they're not taxed in, let's say, in India, right? It's taxed only in the US. So many countries like India and Indonesia and various other countries have been demanding that this moratorium should be relooked at, and India and other countries should be allowed to tax this as well. So US has always opposed this, and if you remember, sometime back we had this equalization levy concept, which was known as a Google tax, which is also applicable on these companies. Due to US pressure, apparently, we revoked that position. Now, all these things will come back on the table, and it's likely that we will now look at a renewed angle as such when it comes to taxation of digital services. This will obviously have far-reaching implications, also from the perspective of the General Agreement in Trade and Services, the GATS as it's known as. And look, it's a different regime that we are looking at right now.
Yeah, but as of now, just to confirm, because we have a treaty with the US, there is absolutely no withholding tax or any other format of tax that is levied by the US on Indian IT services companies. Correct, Nikhil?
So I think there is no direct impact on IT services per se, but if it's performed in onshore in US, there are tax implications.
Yes.
There are also aspects wherein high visa fees are often levied as a disincentive for provision of work from US itself, but directly when you're providing services, there is no direct impact.
Right. Gentlemen, morning. Mr. Natarajan, if I can come to you. How do you think about this? Is this possible? Are services tariff taxed anywhere? As Nikhil said, if you do work onshore, then of course you pay tax there. But for services rendered out of India, consumed in the US, right? I don't think there is any tax which is paid, anywhere. What is your sense? How will this play out?
No, you're absolutely right, and I don't think it's very likely. And I think, as the anchor was mentioning, there have been many attempts in the past to do these outsourcing bills, etc. And what I think Senator Moreno has tried to do is something very similar. But in that sense, I think the first point of resistance will come from American corporates themselves. I mean, every significant corporation in the Fortune 500, and indeed most of the IT CEOs who were at dinner with President Trump the other day, I think they all have huge investments in India, in GCCs, what is Global Competency Centers. There are over 1,600 of them in India. Plus, of course, the fact that a lot of their work is done by Indian companies. So I don't think this is going to happen in a hurry. So I'm pretty sanguine about that. And you're absolutely right. I mean, if there is a tax on Indian companies for exporting stuff, it's almost a double tax because we also pay tax in the US. Yeah. And if the tax as is proposed by Senator Moreno's bill, if that is on the company which is doing the outsourcing, that's really a double whammy for them. So I find it very unlikely that this bill can go through in its current format. Yeah. However, having said that, I think we need to be wary because till such time as somebody said, I mean, we wake up in the morning and it's good news all over. We have to be wary because anything can happen. And from very conservative Republicans and even White House advisors like Pete Navarro, for instance, we have to be wary of what might come next. But at the same time, nothing to panic about.
Do we have, so for, say, a large IT services company out of India, any listed company, right? 100 rupees in revenues, how much is work done in the US and how much, because offshoring in that sense is also a bit of a loose term, right? Some stuff is done outside, some stuff is done in the US itself. Do we broadly have that proportion for the industry, Mr. Natarajan?
See, you have to look at it in volume terms and value terms. So in volume terms, I would think that in a mature outsourcing contract, almost 75 to 80% of the volume of work is done offshore, which could roughly translate to maybe 40% or 50% of value being generated in the US and the rest of the value in India because of the price differential, as you can imagine. But having said that, I think there is a significant amount done offshore, which is the advantage both to the company as well as, of course, to the client. And which is why I'm saying that that will probably continue.
Well, let's see. Just hope some of the social media posts, including one that came in from Laura Loomer, that this remain sort of views on the periphery and nothing more than that. Before we let you gentlemen go, Mr. Natarajan, you're an industry veteran. Must ask you this. And beyond all this, taxation is fine and what changes, what doesn't. But large Indian IT services companies, from an investor standpoint, are also facing a bit of a real existential growth issue with what's happening, the kind of AI disruption that's happening. And investors are asking tough questions because growth is just not coming by. How do you see this playing out over the next, say, 2-3 quarters?
I think 2-3 quarters is going to be probably, tepid at best, because it's not just AI, it's also automation, it's also a demand issue at this point of time. In the medium term, I don't think there's a problem because most Indian companies are very much ahead of the curve when it comes to mastering AI as service providers, as well as using AI ourselves in our work. But even in our own company, GDT Data, our reliance on data engineering and AI is very, very high. And we're seeing lots of positive signs in the market. But yes, it'll take some time for the next sigmoid, if you will, to take off. But once that takes off, I think it'll be business as usual. So I'm pretty optimistic about the future.
All right, Nikhil and Mr. Natarajan, thank you very much. Short conversation, but we need your expertise as the story develops. If it develops, I hope it does not. And, it's just that reports and stuff which has happened in the past but doesn't go anywhere. Thank you very much, both of you. We'll take a quick commercial break here. We're going to come back and Sudarshan and Mitesh are going to be with us with technical trading ideas. Stay tuned. Coming up. Okay, welcome back. Let's just get the technical trades now. Sudarshan Sukhani and Mitesh Thakkar are with us with exactly that. Gentlemen, great to have both of you here. Appreciate your time. Mitesh, what's your sense? How are things set up this morning? Do we get a bit of a lift and will that stay? How do you trade it?
Yeah. I think the GIFT Nifty is indicating a modestly positive opening. Thereupon, I think the broader setup still remains Prashant contracting, which means that we might not see a move beyond 25,000, 25,200 levels. And on the downside, 24,400, 500 zone will be holding out. This means that broadly in the index, you can deploy range strategies. So if you get declines to about 24,500, 520 zones, that's your area to take some long positions, and around 25,000, try to take profits. But more focus should be on stock specifically.
Okay. Sudarshan, what about you? How are things set up according to you?
Yeah, good morning. See, the Nifty is now in a trading range of some kind. The lower levels are not very clear, but the higher levels are around 25,000. So any trade in the Nifty should be done only on the buy side, but on a sharp dip or intraday correction, not at the open. So the trend still remains up, but a choppy market can cause a lot of pain. So look for dips and then go long. If you don't have a dip, wait patiently.
Okay, all right. Good morning, gentlemen. Good to see you all in. Mitesh, let's come across to you first. What about stocks in focus?
Morning, Nigel. Couple of metal names on the buying side. NMDC. It's been a call earlier as well. Now can be bought afresh with a stop below 73, 72.9 at. Look for a target of 78. Similarly, Tata Steel had a big breakout on Wednesday. Then Thursday we saw some pullback and Friday a bounce back. So signals of continuation here. Buy with a stop at 164. Look for targets of 177. Astral is the other buy call. Recommend buying here with a stop below 1433 for targets of 1500. And RBL Bank managed to get past this 269 to 70 zone, which was an important level. So now that it's cleared that, there could be more upsides. So buy with a stop at 268 for a target of around 280.
Okay, all right. Sudarshan, coming across to you. What's on your radar?
Yeah, just a small point. Today is the start of Pitru Paksha, when we remember our ancestors. And whom do I remember? I remember Mr. R.H. Patil, developer, creator of the NSE every day. He gave us freedom and independence to Indian investors. I sometimes think, what would the world be like if the erstwhile PSC were still in control? So I thank him every day. Now for my trades. Fortis is a buy with a stop under 930. You talked about Vedant. Vedant is in my list as a buy. I also have some small shares in it. So Vedant is a buy with a stop under 436. HAL is a buy. Again, I have a small investment in HAL. It's a buying opportunity with a stop under 43.28. And M&M is my final buy, stop under 34.92. The trend is up. We should be looking for dips to go long.
Yeah, no, absolutely. That was a wonderful sentiment there, Sudarshan. Thank you very much for sharing that with us. Mitesh and Sudarshan, thank you for joining us. Good speaking with both of you here. 5 minutes to go for the market pre-open to kick off. We're going to take a quick commercial break here. We'll come back. Sudhir Sitapati of Godrej Consumer Products will be with us to discuss the impact of GST cuts on consumption and more. Stay tuned. Coming up. Okay, welcome back. We're, of course, this is Open Exchange. We are coming to you live from the CNBC-TV18 News studios. There's 16 minutes to go, market open. Now, in an exclusive conversation with CNBC-TV18, Finance Minister Nirmala Sitharaman outlined the government's economic roadmap, highlighting GST rationalization as a key driver for consumption without compromising fiscal discipline. Just want to play out that soundbite for you.
There's more money given already through the income tax cut. Right. The rates are coming down. So the citizen now has a choice to meet his aspirations and his expectations. He cannot say, look, I have the money because the income tax is reduced, but these items are beyond my affordability. Now everything has come down. I'll give you this number which is important. 99% of all the goods and services which are touched by GST are now either in 0 or in 5 or in 18. That's right. With consumption going up, there's a potential for capacities to grow, investments to grow. It has an immediate psychological effect that I can do this, which was beyond my affordability. And therefore, I think there will be a buoyancy in terms of revenue.
You know, we've been getting you a whole bunch of reactions across industry segments to understand what this will do. I mean, those comments, of course, coming in from Finance Minister there. And let's talk to, an industry leader, Sudhir Sitapati, Managing Director and CEO, Godrej Consumer Products, Chairman at CII, National Committee on FMCG. Mr. Sitapati, good morning. Great to have you with us here. Prashant this side. 3 basic talking points for our viewers, which we want to discuss with you, sir. Impact of GST cuts, of course. How much will GST cut boost overall consumption, volumes, etc., and any change in growth expectations for FY26, right? So those are the 3 points. Let's just kick it off. Mr. Sitapati, welcome to the program. Could you give us a sense of what do these GST cuts mean for Godrej Consumer? What percentage of your portfolio is impacted? And what kind of volume bump do you see because of this? Go on, sir.
Firstly, Prashant, I'd like to thank the government that both the income tax cut and the reduction in GST across the board, both of these will spur consumption. Consumption has been a bit soft for a few years, but we have no doubt that a combination of these two, income tax and GST, will spur a consumption growth across sectors, not just for Godrej consumers, but I also speak wearing my CII FMCG hat. I think across the sector, it'll boost it. I think all of us are committed to dropping prices and passing on the GST to consumers as soon as possible. Now, having said that, to answer your questions, as far as Godrej Consumer goes, the main benefits are in the soap category, which is about 35% of our business. It's hard to judge how much volume growth will come at this stage. Certainly, it will grow faster than what it's grown in the past. But I think one of the advantages of GST is not only the categories where GST has reduced will benefit, but even categories where GST has not been reduced will benefit, because the overall spend on consumption or available spend on consumption and discretionary expenses will go up. So we're bullish not just on soaps or on the products that have benefited through GST, but even on the other ones.
So you're saying as you see it for now, direct impact is the soaps category for you, which is about 35% of your portfolio.
Yes.
It'll show up the maximum there.
Yes.
And what is it growing? What has it been growing at? And ballpark, and we'll not hold you down to numbers, but any sense on what can happen here?
See, the soap category has been growing volumes at about 2% a year for the last 4-5 years. So it's not a very high growth category, but it's an essential category. So the category growth may go up by a couple of percent, but more importantly, because it's a reasonably large part of household expenditure at the bottom of the pyramid, it will free money for consumption in other categories.
Hi, Mr. Sitapati. Good morning and good to see you. And clearly, this measure is going to be a bit of a booster shot. But in the near term, do you see some disruptions due to stocks at dealers? Because we have that interim period, right, of roughly on 12, 14 days odd.
There certainly will be some disruptions, mainly because the FMCG sector operates on an MRP regime. It doesn't operate on an end consumer price regime. So, the stocks that dealers are sitting with and what companies are sitting with are sitting at higher MRP. And just by passing on money to trade, it doesn't guarantee, in fact, it won't go to consumers directly. So there is a little bit of lag time before the MRP changes. Probably early next month or mid next month is when consumers will start seeing the reduced prices on FMCG.
All right, Mr. Sitapati, you said that this move is positive, but it'll be difficult to quantify it, right, in terms of what kind of benefit it could have on volumes, how does it change growth projections. That said, will Q2 be a little bit softish because of this uncertainty in the near term? And were sales as is impacted because of heavy rains, adverse weather conditions as well, even prior to this GST rationalization?
Yeah, I think it is hard for me to judge what will happen in September. There will certainly be a lot of pipeline changes in September, and therefore September 15 days could be choppy between now and the end of the month. But I think it's a very short-term thing. I think a combination of the GST price reductions and the available income basket for consumers will certainly mean a good Q3 and Q4 for all of us.
But Mr. Sitapati, you're not telling us that if that translates into this current fiscal, looking better than what you had earlier envisaged?
I certainly think this current fiscal will be better for most companies than what we had envisaged, because this is a meaningful and material change in a large part of ours and other people's portfolio in terms of consumer pricing.
Also, sir, while GST obviously is a big positive, large parts of the country have received extremely heavy rainfall, particularly in the north. Could that weigh on the way the business is shaped up in Q2? Has there been any meaningful disruption in your supply chains, in your end user markets, particularly northern states?
There has. In the end of August has been many states were shut down and due to excess rains. But it's difficult to judge. About 5-6 days were definitely interrupted at the end of August due to rains. But we'll have to see. The quarter will, how things play out over the next 15-20 days. That will have a lower impact, by the way, on Q2 than the changes that pipeline changes on GST will bring in.
At a wider thematic level, sir, when tax on a certain product goes down, whether it's a hair oil or whether it's a bar of soap, in your experience, does that essentially leave more money in the hands of people to maybe spend on other things? Now, we don't know. It could be any other service, any other good. Or does it lead to additional consumption in the same category? Is there any reason to believe that more soaps will be consumed because of a cut in tax at all?
So I think it's a combination of three things. I think firstly, a little bit more soap and hair oil will be consumed, but you're right in saying that essentials are often not very elastic. And the elasticity of, let's say, categories that have gone from 28 to 18 will be higher. So the second thing that will happen is that these essentials are a large part of consumption, so money gets freed up for other things. But the third thing that also happens, which happened in GST 1.0, is a lot of unorganized sector which pays no tax and which is, often basically, a lot of it is illegal, a lot of it doesn't pay tax. They either come into the tax bracket or 5% makes the branded players who pay tax more competitive when compared to them. So these are the three effects that we expect to happen over the next few months.
Right, Mr. Sitapati. So, interesting to see, interesting times, but the second half of the year obviously should look much better because, things will be rationalized. We'll have more clarity on that front. But, earlier you were talking about, you were giving us a guidance. And do you want to tinker with that? We were briefly talking about high single-digit revenue growth, double-digit EBITDA growth for FY26. Any tinkering out there? And also the India margins were expected to move to mid-20s in the second half of the year. That's on course?
I think so. I think you see there's also been some choppiness in terms of raw material at the same time. So I would still say sitting here today that until we kind of see how GST plays out, how it plays out on pipeline, there are too many variables. So I would still kind of say that, what we thought would happen is likely to be roughly what happens. We will see as things go along whether they get better.
Yeah, absolutely. It's great to get that perspective from you, Mr. Sitapati. Really appreciate your time. Thank you very much for joining us here on CNBC-TV18. Thank you. All right, I think, we've got I think pre-open, which has now come to an end. Maybe, now we can take a look at some of the stocks which are coming up. 60 points higher at the end of the pre-open session. 24,800 plus is where things are at. And... maybe put up Amber if we can, just a bunch of these names, right, which we put out with regards to specific, news flow. Amber is up, Amber will come up. Maybe the metals index and maybe a couple of steel stocks, JSW, Tata Steel, etc. On that Morgan upgrade, Amber is up 0.75%. There is the metal stocks which should come up as well. JSW is up 0.65. Vedanta, of course, is the other on the other side. So slightly maybe negative sentiment there. Tata Steel is up 1 1/3. Vedanta is down 1%, nothing large, but 440 on Vedanta. And maybe, the defense pack as well, because there is Max is at the bottom of the screen. So some news flow related names are there, 3.75% on Max. Defense, and we'll put this out with Dria, our colleague, in a bit from now with regards to the roadmap that the ministries put out with regards to the areas where there'll be procurement, and this is a long-term plan. But that's a defense space for you. So the Nifty Defense Index slightly higher, but it'll show up more in individual stocks and segments. All right, well, let's just get you the 9:10 call. Sudarshan is with us and so is Mitesh. Sudarshan, what do you have?
Well, it's M&M. Consider buying M&M with a stop under 34.92.
Okay, and Mitesh, what about you?
Well, you go with a long call on Tata Steel for targets of 177, 178.
Okay, all right. Before we get to the stock that I want to talk about, which is Vedanta, I just wanted to focus on a couple of another one, that is Prime Focus. I think we should get that stock up for you. I'm looking at the pre-open volume. That's close to 1 crore shares that's traded. That equates to close to around, this is on one exchange. Pull up the other exchange as well. There's close to 1 crore shares, which is close to 3%. So I'm not sure whether or not there is another large trade that's taken place, but we'll have to keep an eye out on that one. Prime Focus is the one that I'm talking about. The combined volumes is more than 1 crore shares on this one. That's one exchange, 5 lakhs. The other one is 1 crore shares also. We'll get back to that.
Nigel, on Friday,
yeah, that was Utpal.
Nimesh had put out on Thursday. That is last Thursday on D Street Chatter. Nimesh had put out that there's a large sort of block deal which will happen on Friday, and some high net worth individuals, Ramesh Damani, I think Madhu Kela, Utpal Seth. I mean, I think they've all sort of picked up large quantities in Prime Focus. The seller is Stanley used to be a long-term holder. They used to own up over 20%. I think that is the block which is coming to the market. It's getting absorbed by many of these individual investors. I think a couple of funds bought as well. So just wanted to point that out.
Yeah, and the bottom of the screen, actually, that cleared the clarification. There was a large trade that took place in pre-open. That's the one that I was talking about. 1 crore shares have changed hands. So we'll have to see who were parties to that particular trade. That explains why we have those large volumes. Moving to Vedanta, well, sources say that Vedanta has emerged as the top bidder for Jay Prakash Associates with a total offer of around 17,000 crores, but that will be over a staggered period. The street will not like this too much, and they will view this as unnecessary aggression, and they have enough on their plate as well. Well, Nuvama, they put out a few points. They say they consider this event as negative for minority shareholders. They're unconvinced by the rationale to acquire the group of assets. They're also getting into an unrelated business when the priority should be deleveraging. And in the demerged entity, this asset will be housed in the Vedanta Limited, where funding of the 70,000 crores could be a little bit challenging. And finally, they say that the culmination of the transaction is likely to restrict any kind of re-rating of the stock. So explains why Vedanta is a little under the weather today. It's not a sealed deal, but the direction that it's moved, the street is not liking it too much. Well, let's go across to Sudarshan. He's here to tell us about auto stocks and Samvardhana Motherson. Sud?
So over the weekend, we have seen that most of the auto companies have announced price cuts post GST reform that was announced last week. And first one is Tata Motors. It has announced price cut in the range of 30,000 to 4.65 lakhs. 4.65 lakhs is mainly for heavy commercial vehicles. And as far as passenger vehicles are concerned, price cut is up to 1.40 lakhs. For Hyundai also, it has announced price cut and it's in the range of rupees 60,000 to 2.40 lakh. And for both these companies, price cut would be effective September 22. As for Mahindra and Mahindra, it has also announced price cut that is in the range of rupees 1 to 1.56 lakh. But for Mahindra and Mahindra, price cut is already effective. That was effective September 6. And apart from these auto companies, Samvardhana Motherson would be in focus over the weekend. Company has unveiled its plan for FY30. And now by FY30, it's targeting gross revenue of $108 billion versus $25.7 billion that company reported FY25. So almost an increase of more than 4x. Also, it's targeting to deliver 40% consolidated ROCE versus 18% FY25. And one important point that company has mentioned that no single country or company will contribute more than 10% of its total revenue, and incremental revenue as far as it's concerned, more than 75% of incremental revenue by FY30 will come from the acquisition that company does in both auto and non-auto. On the tariff front, company is saying that there is no material impact.
All right, Sudarshan, got it. Thanks very much. So Samvardhana Motherson is reacting well to some of those statements. Stocks up 2.5%. Let's look at other stocks. The other one that's reacting very positively to all the news flow that we discussed, our top 10 list, is actually Suntec Realty. Let's pull up Suntec. Promoters are infusing some money in the company, and the market really likes the sound of that. So Suntec is up about 4%. Max Estates also, as they go forward with their expansion plans, reacting really well. These are the two stocks from the real estate pack. Maybe we can pull up Amber as well.
Flattish.
Amber is a little flat. Its subsidiary is picking up a lot of money, 1,200 crores from marquee institutional investors, including, I think, Chris Capital is one of the names. That stock's flat. Vedanta is actually not falling too much. I mean, if you expected a big sort of a drawdown, but let's see, this is pre-open. We'll see how, the market reacts. Right now, it's down about 1%. SpiceJet, let's pull up SpiceJet. Those numbers at the end of the first quarter print, they don't look very promising. There you go, 4% down on SpiceJet. Losses are still a concern. The fleet size is not ramping up as quickly as what one would have hoped for. So those are some of the early reactions, and we're about to set off 60 points in the Nifty.
Yeah, first rates coming up on your screens now, and what do we have? It's higher, 24,800 plus on the index, about 1/3% up. The Nifty Bank is up as well, but not very much, just blinking red and green. The small cap index is up 1/3%. The mid cap index will come up on your screen, and I think there's about a 0.4% bump as well. So yeah, broader markets opening a little better this morning as compared to the Nifty and the Bank Nifty. Actually, Bank Nifty is flat, so that's out of the equation. And the Nifty heat map should give you a quick sense of where there is more green and red. And there you go. So it's largely up and about. And metals, I mean, the two metal names, JSW and Tata Steel, that Morgan upgrade that I was talking about earlier, they're there. And on the other side, you've got a couple of financials, HDFC Life and Kotak, etc. There's ICICI Bank as well. So, but bulk of it, 45 odd names are opening in the green as far as the Nifty 50 go. Surabhi.
It's really metals all the way. I mean, all through the last week, the metals pack has been fired up, and it's all China related. Hopes that production cuts will kick in and therefore stabilize prices perhaps here in India as well. Tata Steel, JSW Steel, 3% on these stocks. Big moves coming through. Even Hindalco is up, but the rally in the party is more in the ferrous space than the non-ferrous space as the day kicks off. Mahindra and Mahindra announcing those price cuts, 1.5% lower. Tata Motors, 1.5% higher. Ditto for Tata Motors, also up 1.5%. Let's see what IT is doing. Not too bad, actually. Remember, IT had a very wobbly Friday because of some absolute fake piece of, information that was floating around. There were lingering concerns, but it seems that the statement from Mr. Donald Trump, that for now is stabilizing IT stocks. The index is up, TCS, Wipro, most of these stocks are also on the upside, so no problems over there. Some of the life insurance stocks are still correcting. SBI Life, HDFC Life, down between 1% to about 0.7%, depending on which one you're looking at. And banks are very quiet. ICICI Bank, Kotak, All of them. Axis Bank absolutely at the flat line. Let's look at HDFC Bank, absolutely flat. Let's see if the Bank Nifty decides to lift off. But right now, a very quiet start for this one. Nigel.
Well, that's right. Let's keep a few stocks on the radar. The newly listed company, Vikram Solar, they won a 336 megawatt high efficiency solar modules. I think that's the reason why post their order win, the stock is up close to 4%, and volumes are very, very high. So that's one stock that I'm noting. The other one is Prime Focus, large trade on Friday, large trade today as well. Well, the street seems to be sniffing some kind of news out there because the volumes are extremely high, more than 3.5%. Actually, now more than 5% of equity has changed hands in the first couple of minutes itself. Sunteck Realty, promoter showing the faith. The street likes it. The stock is up and about. Swiggy is higher. Nomura came out with the note. They have initiated coverage. Target price of around 550 rupees. The stock is up close to around 3%. They are pointing out that the food delivery business on steady profitability path and a key cash generator. So that's a couple of points that they put out there. Vedanta, timing is wrong. The metal index is up. Vedanta wants to foray, and take a new challenge on. Could be positive in the longer term, but for the near term, the street is saying you've got enough on your plate. Just focus on that. And that's why that's actually underperforming in today's trading session. So that's under some pressure as we speak. JTL is another stock from the broader markets that's moving higher on very, very large volumes. And I think there was an announcement over the weekend about Ola, a couple of funds entering as well. The stock was under the weather in Friday's trading session because it was put in T2T. But today it's popping back up. It's up close to around 2%, though it was one of the big losers in Friday's trading session. So a good opening. We're holding at around 24,800. The broader markets, that's the one where you're making the money.
Absolutely. By the way, so it's a 60-point bump on the Nifty. We're at about 24,800 as things stand right now. So it's a decent start. The number one volume-led gainer right now is NetWeb. NetWeb is trading with another 6% pop. And I must say it's completely re-rated, in the last 5 days or so, basically, right? I mean, not completely but maybe a little. But it's gone from what, $2,300 to $3,200. It's gone up $1,000 in about 5 sessions flat, and almost nearing 1 million shares on NetWeb coming through. The other one, of course, was E2E, where L&T picked up a stake. I can't spot it today, but otherwise it's done very well. TBO Tech is back to, it had that big move post the acquisition, then it sold off a little bit, but it's basically back at those high levels, 1,600 rupees or so, 1,615 on TBO Tech once again. What else? Shalby Hospitals had a very large move on Friday, and it went from, basically 196 to about 220 on Friday, and it's up another $20, 238 now, 240 basically. So in 2 sessions, Shalby's done phenomenally well. Prime Focus, of course, we've been highlighting. There's another large crore-odd shares which is traded. So 10 on Friday, 10 today. So 20% in 2 sessions flat. And then you got a name like Mosship. I highlighted this on Friday as well. And Mosship is up another 7%. So again, it's 5 sessions. Stocks gone up from 160 to 260, 266 actually today. So that is Mosship. And by the way, it's the 3rd largest volume-led gainer on the NSE. And that's the reason why we are highlighting it. More than 500,000 shares which are traded on this one.
Just a couple of more stocks, Prashant. The reason that TBO Tech is reacting today is because the deal was announced, mid of the week, but the con call was on Friday post-market hours. So that's why brokerages have come out with their notes as well. In our morning chat, on the day it was announced itself, the early morning, we had said that could be the stock. I think from there it's up close to 20%. The other one we pointed out with regard to delivery-based buying is First Cry, Brainbees. The stock, it was at around 350 rupees odd. It's now at around 420 rupees. A big underperformer, but that seems to be coming back into play. And that's why that one as well are following up Friday's trading session with another 4% gain. So interesting to see whether or not it can hold on to that.
All right. Kenneth Andrade is now with us. He's CIO of Old Bridge Mutual Fund. Kenneth, great to have you with us here. Thank you very much for joining us. Really appreciate your time, and you're back after a while. Kenneth, we've got 3 powerful kind of things which the government's done, government and the RBI, tax cuts, rate cuts, and now the GST cut as well. And perhaps there is more coming. From when we speak with bankers, we get a sense that the RBI is very keen to kickstart growth, and they are looking for ideas in terms of what they can do. From the government side as well, we hear this is the first of many coordinated steps How has this moved the needle for you in terms of your thinking about what can happen for the consumption part of the market, Kenneth?
So yes, I mean there are a number of events that have happened over the last couple of days, including the big GST cut that's been there. So the focus has moved to the domestic environment. Obviously, what's happening internationally in terms of realignment of the trade cycle, we necessarily have to refocus our entire energies into see how we can kickstart the domestic economy. And whether it's the central bank or whether it's the government, we're pulling out as many steps as we can to restart the domestic environment, and it's coming at probably an appropriate time in and around the festive season. So it's going to be good for volumes in this quarter, for volumes going into this couple of months, and that should hold up the economy for a while. So yes, from an investment perspective, the focus is now the investing and the investors' focus is now on the domestic economy. We're heading into one of the biggest festive seasons that are there, and we've got all the right steps to see how volumes hold up during this cycle.
Kenneth, hi, good morning. Great to have you on. So, even if it is maybe only a tactical play, actually tell us if it's going to be more a structural or a tactical play for you. But how would you play this mega consumption boost, festive season boost? Would it be through the durable companies or the AC guys? Would it be through, plain vanilla FMCG? Where do you see some sort of durable improvement in earnings and some degree of perhaps valuation comfort as well?
I think the biggest beneficiaries out here are discretionary spending. Okay, and that's where also the largest cuts have taken place. So you just keep an eye on how the cycle works out, especially for the automotive guys and the large appliances guys. Apart from that, may not be too much for too many of the other businesses, and the other businesses are all relatively small ticket items. But like I say, we should see a large volume throughput. And if you see a larger volume throughput, and if you see a larger volume throughput, the biggest fixed costs that companies are sitting on are the segments of the market which have relatively high fixed costs are the durables and the automotive guys. So those kind of companies should see a relatively higher increase in margins, or should I say profitability going into this season. Now, the second question that you asked me, whether it's a tactical play or whether it's a structural basis. Look, we need to do incremental things because the market and the economy is going to be dictated by the environment, which is both outside as well as inside. We've been through a reasonable amount of high single-digit growth over the last 2 years. With whatever is happening on the ground, they should continue. But I think the economy globally has to stabilize when we can find ourselves into that economy and then start a relatively higher GDP growth from there.
Okay, got that point. Kenneth, shifting the direction completely from local to global now, metals, in particular ferrous. There's a lot of excitement. Now, perhaps it's to do with the fact that China is actually looking at cutting capacity, maybe something else. But what do you make of it? What's your stance on metal stocks? And if you like anything, what part? I mean, ferrous, non-ferrous, or are you avoiding altogether?
So we've fairly indexed to the metal cycle as a fund house. So the fundamentals are all in place. Cash flows, capacity expansion, profitability, the domestic economy, even the international economy. Indian metal companies were doing pretty much okay. Okay, whether it is ferrous and non-ferrous, and the profitability or the near term will always be dictated by events that happen. And whatever is happening with the metal cycle today, it all adds back to incremental amount of cash flow. So if you look at all of these businesses, they're very stable in terms of balance sheet. They're very stable in terms of cash flows. They're very stable in terms of putting capacity to work. Anything incremental will add additional profitability, and incremental profitability actually bodes very well for some of these companies because most of them are getting now funding most of their expansion through internal accruals. So cutting capacity in China is one of the biggest events for the metal business or for the ferrous business to find some kind of price stability, and I think that's what really the market is reacting to in the near term. In the medium term to the longer term, I think we are very constructive on this category of companies, whether it's ferrous or non-ferrous. All of these companies are working with reasonably low cost of manufacturing. And it's a very protected market as far as the Indian environment is concerned. So margins are fairly stable also. So that's where we are. I don't think there's any large price risk on the downside to these kind of names. On the upside, obviously, it depends upon what happens internationally to determine the overall appreciation of these companies.
Kenneth, so you have exposure to metals, right? I mean, as a space.
Yes, we are fairly indexed to that.
Yeah. So run us through what you own, and divide it, if you can, into two parts: what you've owned for a long time and what you bought recently.
Starting with metals, I think that's been in the portfolio from day one. We've got both exposure to the ferrous side and the non-ferrous side. That would be close to about 8% of the entire portfolio. We've been holding on to the category of pharmaceuticals that are there, mostly companies indexed to generics. I think a lot of capital is getting deployed out there in terms of finding a business model. Now there will be question marks around is this the right time to hold these companies? But this is the right time for entrepreneurs to find their business model out there. And if I just step back a little, it's not everyone's right to win in whatever is happening across the world. You got to pick entrepreneurs who are reshaping their business model to address a structural change in the way business is actually getting changed. So we're not very apprehensive of that cycle. We're going down company by company and allocating capital into some of these businesses. Okay, from a discretionary spend side, I think real estate has been a reasonably large holding. Aviation is there for since the start of the fund. We've got an automotive business or Maruti, so as to say, which is about 5.5% of our entire holding. That's been there for the last 5 or 6 months, which has been a recent entrance, of course. And we hold a couple of small names in the QSR and the discretionary spendings on the alcohol side. So that's our discretionary basket put together. That would be close to about 32% of the entire portfolio right now.
So how many stocks in total, Kenneth?
We run with about 22 stocks. The category that we address is the focused equity fund, focus category, and Old Bridge Focused Equity Fund is the product out there.
Okay, so fairly sort of diversified in that sense. Nothing, of course, nothing in IT. I don't remember you holding IT services in any good measure.
Well, there's this one business that we hold, which is an HCL Tech, and that's a reasonably large part of it. So when you hold 22 names, each of these names will be between 5% and 8% of the portfolio, right? So it appears to be large, but it's a very well diversified in terms of weightages.
Kenneth, before we let you go, maybe a view on defense. We'll get actually Ria up in just a second to talk about this 15-year new roadmap, which the government has announced in terms of procurement and where the focus areas are. Everybody understands and perhaps agrees that it is a long-term sector here in India. It's here to stay. But the question is what part of it to pick? Where is there some valuation sort of headroom? Your thoughts?
Well, in terms of valuation headroom, I think a large part of it is already captured, and not just in the domestic environment, but also in the international environment. So that's where defense stands. It's a long-term play. The capex cycle is actually started. You've already got the numbers out there. You can value these companies based on whatever numbers that's coming out from individual governments out there. Any export opportunity that is there for some of these companies would be the upside if it's reasonably large. But I still tend to believe that this will largely be driven by government capex on the ground. Valuations are tight. I don't think there is significant space for valuations to move northwards. It's just left to how these companies can deliver in terms of earnings and in terms of how their balance sheets fall in place.
Okay. All right. Good to have that advice. Thank you very much for joining us this morning. Appreciate you taking out the time. And we look forward to connecting again soon. You have a good day. Thanks. Well, that's a view coming in from Old Bridge Mutual Fund. Now, since we were just discussing defense, let's understand what is this 15-year roadmap which the Defense Ministry has outlined and what is going to be the focus area. Ria is here with the fine print. Ria.
Well, yes, good morning. Let's understand what this defense roadmap is about. The Indian Defense Ministry has laid out a 15-year roadmap for the industry, which is essentially a blueprint guiding the armed forces technology and equipment needs till the 2030s. And it focuses on modernization, innovation, as well as self-reliance. And although it is not a purchase commitment, it does signal future priorities. First, coming to the priorities for the Indian Army, they will be focusing on next-gen tanks, which includes active protection systems for T-90 tanks as well as FRCVs, which will replace the T-72 tanks and light tanks as well. For missiles, they are looking to procure 4th and 5th gen ATGMs, air-to-air missile systems for helicopters, as well as ULP GMs. And for communications, they will be looking to procure advanced integrated electronic warfare systems. For the Indian Navy, they are going to focus on nuclear-powered warships, which will include nuclear propulsion for future aircraft carriers as well as other surface combatants. And they will also focus on modernizing their fleets, which includes next-gen destroyers and frigates, next-gen corvettes, as well as next-gen fast interceptor crafts, as well as MCMVs. They are also going to focus on surveillance and sensors, which includes airborne AESA radars for fighter aircrafts, oceanic satellites, and electro-optical sensors. And lastly, they are going to focus on autonomous systems, which includes high-endurance autonomous underwater vessels and unmanned mine countermeasure suites as well. Coming to the priorities for the Indian Air Force, they are going to focus on long-range precision weapons, which includes cruise missiles, guided ammunition, air-to-surface missiles for fighters and bombers as well. They are also looking to procure space or air-to-ground high-speed communication systems, as well as drone or UAV-based signals intelligence and electronics intelligence. There are also some requirements, some joint requirements for the tri-services, which includes remotely piloted aircraft systems, air-to-surface and surface-to-surface missiles, as well as hypersonic missiles, for which they are looking to procure over 500 scramjet-powered systems. And the last thing they will be focusing on is AI-driven warfare, which includes advanced electronic warfare, counter-UAS systems, as well as next-gen targeting. Now, who stands to benefit from all of this? Essentially, all defense players, once the final procurement approvals or these orders flow through, which includes your PSUs like HAL, Bharat Electronics, BDL, all three shipyards, as well as the private defense players.
Okay, so the entire ecosystem benefits eventually, starting first with, of course, the heavy lifters, the big PSUs. Got that point, Ria? Thank you very much for giving us the details over there. Let's look at the market. Quick glance before we move on. Market's actually cruising along quite nicely, 85 points higher on the Nifty. 24,800 is here. So let's see. Well, we've been in conversation with a number of companies to understand what the GST cuts are going to mean for the companies and for the individual sectors. And we are putting the spotlight now on the auto ancillary space. Sunil Bohra, Group CFO at Uno Minda, is with us now. And of course, our three talking points are the overall impact of GST cut on auto parts, specifically on the company. What is the impact on volumes and margins? And then what do these cuts mean for EV adoption? Because the tax differential between ICE and EVs reduces with the kind of cuts that have been announced. So let's go step by step. Thanks very much, Sunil, for joining in. So let me start right there. First of all, how much of your, in terms of by revenue, how much of what you were producing was in the 28% bracket, which now comes down to 18%? So how should we start understanding the impact on your company and what happens to the existing inventory in the pipeline?
So starting with your first question in terms of the products GST 28 versus 18. So large part of products were actually in 28%, which will get into 18%. But because we are primarily into a B2B business, which is almost 90% of our revenues come from the direct OEMs. So there you won't see any impact because GST, we all know, is a pass-through. So from that perspective, there is not going to be any impact. But yes, from a B2C perspective, which is the aftermarket segment, which is almost 9-10% of our revenues, definitely their prices will come down in line with the tax cuts. And this, we do hope that that will bring in some sort of a consumption. But it's a little early to comment because the consumption which we see in aftermarket is primarily a need-based consumption where you want to replace products which you need to, and you don't just replace like that just because taxes have come down. So you may not see any significant impact, but yes, it will bring the prices down in the B2C segment. Large part, 90% revenue B2B, as I said, no impact.
And how is the implementation going to be carried out? My second part of the question was just to understand the technicalities of it. How do you mark your current inventory? Because 22nd onwards, the tax level will be lowered, right?
Yeah, absolutely. So from inventory perspective, obviously they are currently carried at cost only. We don't carry including GST. So whatever GST you pay, that is anyway taken up as an input credit. So that lies a credit in your GST account, and the new revenue which happens post 22nd of September will happen at 18%. So from a pure B2B perspective, definitely it's not a significant impact other than just changing your rates.
It's pretty smooth, yeah. Okay, got it. So the transition for you remains very, very smooth. 9 to 10% of your business is B2C, and that's where we need to see if there can be a further leg up. Got that.
All right. Hi, Mr. Bora. Good to see you in, sir. So clearly, this will spell better times for the way ahead. But a quick question, does the GST reduction impact your pricing competitiveness in comparison to imports? Is there a threat of imports?
Not really, because when you import, there is a separate custom duty or the taxes plus the GST. So from that perspective, we don't expect any significant impact because when we sell, obviously we sell at cost plus GST, and when you import also, you have to pay similar taxes, which you can avail the input credits.
All right. Now the hope is that demand comes back. But what were your observations for majority of the second quarter? Was demand okay? Was it faltering a little bit? Many on the street believe that, tariff or not, there were some measures that were needed to be taken internally, and that's been taken. So what is your analysis of demand?
So from our perspective, our demand is primarily to our end consumers, and that has been on the trot as per the annual guidance and the month-on-month guidance which we get from our customers. So from our perspective, whatever components get into vehicle manufacturing, there has been negligible, I would say, no impact or no meaningful impact from this rate transition, because we all know because of this anticipated rate cuts when it was announced to when it is impacted, there has been some deferment. Maybe people would have chosen to defer their purchases for the time being because of this anticipated benefit. But despite that, our customers have been continuing the production because it was primarily deferment for a few weeks, and it is not seen as any significant downside. In fact, we are expecting that post this rate cuts in line with the industry, we do expect that the demand should go up. Now, how much it will go up, everybody's in like wait and watch mode, because this definitely brings the prices down, as we all know, significantly, and affordability definitely increases. So government has done multiple actions, we all know, right? Leaving more hands of money in the taxpayers' hand by reducing the tax rates or the 12 lakh rupees of tax exemption. Then now we had these rate cuts by RBI in terms of interest rates. Now we have these GST cuts. So affordability definitely has improved on various counts. So overall industry is very, very optimistic.
Sunil, hi. Morning. There is a tax cut here. There is indirect tax hike in the US. A lot of these one-offs. But at a fundamental level, can you give us a sense of how business is progressing? What's happening? How's demand otherwise on a steady state basis across your product categories? What is the direction of travel?
Prashant, we continue to have our same trajectory. There is no hiccup. In fact, there are positive signs. Industry is preparing for the next leg of significant growth. We all know all our customers are expanding, and so we are. We have almost 12 new plants which are under construction, and we are quite optimistic that the growth momentum or the phase currently we are in, that is here to stay for a quite long time. So from volume perspective, yes, they have been broadly in line with what we have been estimating. And from 22nd of September, we are all gearing up for meeting our customers' demand should there be an increase in end customer demand.
Many of these, of course, many of these OEMs have already passed on, right? Effective immediately. They're not waiting for the 22nd.
Right. You're right.
So in that sense, I mean, you should be hearing from these from the OEMs. I mean, now, in the sense, right? Of course, depending on what they are seeing on the ground after these price cuts.
Yeah. So that's what perhaps a little early to comment what they're seeing on ground, because to pass on the message till the end, it will take some time. But as I said, there has been no impact on volumes because of this anticipated cut post 15th of August. And our customers have been sort of building up inventory. And from that perspective, our operations have been going in a very steady, smooth way.
So all things put together, Sunil, this year, what, 20% growth? More than that? Less than that? Teens?
Very difficult to say, but I can tell you that in the first quarter, we all know industry grew by a couple of percentage points, and we grew by almost 16%.
Yeah.
So obviously, we do expect industry to grow, and hopefully, we should be able to maintain our growth rate what we have delivered in the first quarter.
The third point we wanted to understand, Sunil, was whether this move on GST, whether it fundamentally changes the whole roadmap of EV adoption. Because ICE vehicles suddenly get that much more affordable, right? So the propensity of just going in for an ICE becomes very direct. What's your thought on this?
Very difficult to say, honestly, because there is a section of a consumer which is preferring EV because of not only the cost differential, but also because of the cost of running, cost of operations, and maybe impact to environment, etc. A lot of regulations there now which are driving in terms of what vehicle you can drive on road, because we all know the pollutions have been spiking. There are various factors why people have been adopting for EV. Yes, this price reduction might impact a little bit, but we are in a very nascent way or nascent stage of the EV volumes. Two-wheeler is somewhere around 7 to 8%, three-wheeler is something around, four-wheeler is around 3 to 4% of overall volumes. We are very small and base, so it has to grow. Now, how much it will grow, its time is only tell, and that's why we say we never normally sort of try and speculate what the penetration is going to be. But overall, long term, we still believe that the numbers where we are today will increase despite this, what we call the price differential being reducing.
Sunil, we leave it there. Good luck and, all the best as you continue to execute when what seems like a pretty good trajectory of growth for you. As you said, 12 new plants under construction. Growth over a long period of time. There'll be, of course, pulls and pushes and a little bit here, a little bit there, but seems to be on pretty good track. Thank you. That is Sunil Bora of Uno Minda with perspective on the business. 24,800 on this Nifty. We're up about, 90 odd points right now. I highlighted NetWeb in the morning as we opened up. NetWeb was up 7%. It's cooled off to about being up 2%, but it's still the number one volume-led gainer right now. Moschip is still up 8%. There's another company called, MICEL. It's not a new company. It's been around for a while. It's basically MIC Electronics, basically. It's shortened to MICEL. It's up on very large volumes, some 1,700 crores in market cap, $77 on your screen, and 17%. Very large volume. Number 5 across the NSE. So you've got many of these shooting stars coming up, right? Look at JP Power, 5% higher on JP Power. Again, very large volumes at this point in time. And of course, some of the other stuff is we've already highlighted. Volumes are still picking up through the course of the day. By the way, on the Nifty, we're up 90, but we already had one dip. The market was up 60 points. It sold off to being absolutely flat. And then this is now the second move higher, which we are seeing at this point in time. We'll take a quick commercial break here. We're going to come back and banks and financials and focus on the other side. We'll have Vishal Goyal of UBS joining in to talk about exactly that. Stay tuned. Coming up.
Welcome back. Well, we are continuing to decode the implications of this big boost, economic boost that's been given in the form of the GST cut. We're putting the spotlight on the financial sector now. Vishal Goyal, Managing Director, India Financials Analyst at UBS Global Research is with us now. And of course, we want to cover three talking points. Credit growth and how might that shape up from here on? Of course, what are the expectations from the RBI? And of course, bank earnings. Really, will things get better as we progress down the line into this year? Vishal, great to have you on. So let's take it step by step, starting with point number one. Now, a lot of people believe that maybe a good way of playing the GST cut, the stimulus that's being given to the economy, would be through financials, because eventually, perhaps, people borrow more. Do you have that view? And where are you in terms of your expectation of system-wide credit growth? And which are the, the subcategories of financials which will perhaps surprise on the upside, purely in terms of growth?
Hi, Surabhi. Thanks for having us. So, yes, I guess the H2 expectations are generally high. Like we are all expecting the rebound in H2. And thanks to the stimulus from government in various forms, whether it starts from the IT rebate, GST now, plus the monetary easing, which we have seen. So we are from deficit liquidity to now surplus liquidity. So I think all this should enable some pickup in the credit growth. Now, from current 10%, we are estimating it to go to 11 to 12%. And a lot, of course, will depend on how the festive season goes and how the consumption cycle picks up. In terms of, I think, the breakdown, we still feel the consumption will continue to drive the growth for the system. I think the corporate capex is still small to drive overall growth. And therefore, I think it will be largely consumption-driven, partly supported by SME lending. And those two remain the key drivers. In fact, in our recent publication on thematic for next 5 years, also we kind of highlighting that there is room for more growth from these two particular segments.
All right. Hi, Vishal. Good to see you, Ben. But what's your approach, from the financial pack itself? Because that could be one way of playing it. But would you go for the NBFCs, private or public sector banks?
Yes. See, I guess, again, if you think from a growth rate point of view, NBFCs clearly, has been growing at a faster rate than banks even in past. I feel the environment is still supportive, easy liquidity, lower rates. They definitely.
Oh, I think we've just lost that line with Vishal. We'll try and reconnect with him in just a bit. Quick check on the market. By the way, the mid-cap market is really having a great Monday because the mid-cap index is outperforming the Nifty by a mile. And you have a very positive advance decline ratio as well on the NSE. Almost 3 stocks are advancing to just 1 declining stock. So it's looking good. Let's figure out what's moving then in the mid-cap market. We've discussed, of course, TBO Tech, but there are other names as well. One MobiKwik is on the move once again, 8.5% on the higher side. There's Acme Solar, there is GMDC, Prime Focus, where a bunch of very notable investors have checked in, including Mr. Ramesh Damani. That stock's locked up in 10% circuit. It hasn't moved, hasn't budged at all. So these are the key names on the upside for the time being. Let's just go back and check some of the stocks that were on the radar in terms of news as well. Vedanta is still stable. Still down only 1.5 to 2%. And the real estate stocks, Suntech, where promoters have infused some money in the company, 500 crores, 3.5% up on Suntech. And Max Estates is also up and about.
Well, that's right. Let's focus on metals, though. And Morgan Stanley has come out with a note on steel. They have upgraded JSW Steel to overweight. The target price they've raised to around 1,300 rupees. They've also gone ahead and upgraded Tata Steel. The target price comes up for you on the screen, 200 rupees. And SAIL, the target price has been raised to around 150 rupees. 140 rupees, beg your pardon. They have an equal weight, though, on Jindal Steel. That target price they've raised, though, to around 1,150 rupees. Let's tell you the factors at play. They have turned constructive on steel spreads expansion. They're also expecting domestic steel prices to expand as the demand is likely to improve. They point out that China's anti-involution theme is also gaining traction. That is, they'll restrict production, restrict supply, which in turn will be good for pricing. And since China's the big king in terms of the capacity globally, well, if China does that, then that's good news for global prices as well. They say that the global macro factors are also turning favorable. And because of all these factors, they've gone ahead and raised the steel prices estimates by around 3% each for FY27 and FY28. So put all this together, Morgan Stanley has got constructive on steel companies. And last week itself, here at CNBC-TV18 had highlighted various factors at play, from anti-involution, from Fed rate cuts, the kind of measures taken by the domestic regulators here, or the central government as well, to protect domestic companies. And all these companies have done quite well. But I think Vishal Goel is back with us. Vishal, you were going to give us the preference, between NBFCs, private and public sector banks. Please go ahead, and good to have you on camera.
Yeah, sorry about that. I guess, I was saying that NBFCs have historically grown faster than banks because, they have smaller books and again, focus more on consumption. Given the benign liquidity environment and funding environment, we feel that NBFCs would continue to grow faster at roughly 1.4x of banks. Banks also have corporate and agri books, which are not growing as fast as retail. And that's why I think NBFCs should be growing faster than the banks, even in the near term.
Okay, so NBFCs will grow faster than banks. Within NBFCs, Vishal, which segment are you more optimistic on? The ones that are more, say, gold loan focused, or is it going to be housing or consumer financing? We all remember what happened to Bajaj Finance, right? Just after the GST cuts were announced. So what type of NBFCs?
Yes, I think, housing will remain the largest, product along with business loans, which is SME and business loans. So those are the large two products. Actually, consumption lending in India is still very small. Like, if you look at credit cards, it's only 1% of GDP. Even personal loan plus credit cards will be like 8% of GDP. So I think there is more room for consumption credit to grow. We have seen some consolidation in this product in the last 18 months. Also, we've seen an NPL cycles in 23. And therefore, I think this segment can grow faster, especially given that the GST stimulus would be directed towards more on the consumption and basically should have some effect on that lending as well.
Okay. So that's on the NBFC side. For large banks, Vishal, what's the forecast as of now? Do you expect any of this? The fact that, the income tax cuts have also now, they're seeping through the system. This is a year that they're at play, and then the GST cuts. Large banks, how should one consider them, if at all?
I guess large private sector banks, they are still driven by consumption credit, and retail remains a large part of their balance sheet. So to that extent, they should be able to grow closer to 14-15%. And that is like our, range forecast for most of them. I think in terms of margins, we already know that this repo cut repricing would have some margin dilution in the near term. But beyond that, I think as we go closer to FY27, probably Q4, we'll start seeing NII growth also coming back for them. So I would say, we'll work with 14-15% loan growth for this year, probably more NII growth next year as the margin stabilizes.
Vishal, even, I was shocked to hear it, but even the rate of growth in home loans as a segment, that has fallen very sharply, right? Single digits now. Sharp deceleration. So in terms of segments, where do you see the maximum delta if this is to pick up and go the other way?
I guess the maximum delta would still be driven by consumption, as I was saying. And within consumption, we have already seen, as I said, correction in the unsecured lending. That should start picking up. Gold has had a very good run, right? Backed by the price grown at almost 30% CAGR in the last 5 years. But that, I think, might still, continue to grow at faster than the credit, like maybe closer to 15%. I guess SME credit, business loans and SME credit, that book would also continue to grow faster than the overall book. So those 3-4, I think I would say segments. Auto, etc., would also see some pickup just because of the stimulus. But I think at the overall, scheme of things, the size would be small.
So basically, a consumer and SME kind of loans, right? Those are the two areas.
Yes.
Right. Yes. That's exactly. We spoke with Sanjeev Bajaj last week, and those are the two segments he identified as well. And actually, other CEOs we've spoken to as well said, well, this is where the maximum sort of boost, etc., will show up. Just one more question, Vishal. Many banks and bankers we speak to say, well, the regulator is still very keen on doing more to reverse the sentiment and for lenders to be able to lend more in an easier way, etc. We've heard things like, a relook at risk weights on specific segments could be in the works. In terms of future steps from a regulatory standpoint, now rate cuts, is it one or done? Are we going to see one more, etc.? We don't know. But is there other steps which could be meaningful? What could those be, Vishal?
I agree with you, Prashant. I think since March or April, I think regulatory situation is very different. I think from a tightening on all fronts in the last 2 years, we are seeing, relaxing and accommodative stance on not only on monetary and repo cuts, but also on some of the regulations for banks, whether it is ECL or provisioning or, like the risk weights on unsecured, LDR related, pressures, etc. So I guess there is at least a benign, environment from a regulatory point of view for growth to pick up. I guess now liquidity is already in abundant, right? So I think what regulator generally can do is relax more on LCR or, some like for the CRR cut also would be happening. So a lot has already happened in the near term. I guess if this does not pick up, then they could look to maybe, relax some more, internal regulatory, I would say, measures, which allows bank to lend more from the liquidity. But I guess I think the task at hand would be credit demand, right? Like how you get the demand to come back. One can be just simply lower rates. And the second could be, all this stimulus, which is already happening on the other side.
Yeah, and both have happened, right? I mean, to some degree, at least in the near term. Vishal, just one last question from my side. When you speak with foreign investors that you advise on for stocks under your coverage, how is positioning in this space now relative to, and is that a factor at all, one way or the other? I remember a year and a half, 2 years, till 2 years back, I mean, the refrain seems to be, well, everybody likes the space, but everybody's already overweight. So then what's going to happen from here? But has that changed at all? Has enough time correction happened? What's the sense?
Yeah, I'll go back a little back in time. See, if you look at the positioning in the last 6-7 years, how it has evolved, it's basically, it was hidden only defensive names, right? Some quality private sector names, no exposure to SOEs, no exposure to the smaller or no struggling private sector banks. From there, it basically became almost everything you own in the sector. That basically happened maybe a couple of, till maybe last 18 months. And in the last 12-18 months, what we are seeing is again some shedding, I would say, or reduction in the low quality names. Or low quality in the sense like the names which are not performing as much. So within private sector also. And so overall, I would say it's difficult to put a number whether how much overweight was there. But, from high overweight, it could have been a low overweight or, the weight definitely has reduced. That's the sense I think we get when we speak to them.
All right, Vishal, the last 3 or 4 years, if I were to pick up one set of finances actually that have re-rated, could be the power financiers. They have really moved up. Do you think there is still value out there? And also, if you could comment on gold finances, because, this is an ancillary way of playing the theme. If you're bullish on power, maybe if you want to play it via the financing theme, then some of these power finances have done well. And we saw a couple of those gold finances, the numbers that they have delivered, and those stocks have, seen a big spurt up. So do you think there's more potential?
Yeah, I guess, Nigel, gold is, the price has helped. Plus, like if you see the gold AUM CAGR is 30% in the last 5 years. So it's phenomenal. Like it is kind of the best in the overall financial services in terms of growth. Can it continue further? I mean, lot will also still depend on, whether the gold price, remains here or there is a sharp correction from here. We don't cover the names in particular, but I think we are expecting around 15% growth from this segment, given that the base is already very high. There's nothing, wrong in the business as of now, but generally, I think we think from a very high base, we should see a 15% kind of CAGR over that. I think on your question on power finance, yes, I guess we are positive on that segment. I think in particularly because the valuations are reasonable and ROE, etc. are decent. I think in terms of growth, while there are a lot of discussion about growth picking up, I guess the struggle for this financiers has been the loan growth numbers, right? And the low teens or close to teens kind of growth numbers is what right now expected. If that surprised positively, I think there would be a good re-rating potential in some of these names.
All right, Vishal, we'll leave it there. Thank you very much for joining us. It's a good conversation and good insights from you as always. Thank you for joining us here on CNBC-TV18. 80 points on the Nifty is what you have, so 24,824. We've been highlighting all the names which are higher. I just want to look at the other side as well. By the way, it's one way. So advanced decline, 2,000 up and about 700 lower. So almost 3:1 in terms of advances to decline ratio. Amber is down 2%. It's basically from the highs. It's come off quite sharply. And I'll tell you, from on Friday, it closed at about 7,800 bucks basically was the close. It rose to about 7,850 and now stocks at about 7,600. So it's actually dropped quite sharply from the opening gap up that we saw on that one. That is Amber. Lots of other stuff also moving, but I mean the weight of volume, etc., is largely on what is going up, not what is going down. Vinay Rajani is with us, a senior technical and derivative analyst at HDFC Securities. Vinay, good to have you with us here. Good morning. How would you trade the market? What would you do on the Nifty indices, and then of course your stocks?
Yeah, good morning and thanks for having the show. So 450-point rise from the lower level, 24,400 is a very strong base. From that we saw a bounce back and gradually Nifty is getting strength. Now it is above 5, 10, 20, and in fact today it has surpassed the 50 days EMA. So gradually markets are getting strength. Overall, if I were to talk about the 24,400 to 25,000 is a broader range for the market. And for as far as Nifty is concerned, yes, above 25,000 we will get a confirmation of a bullish breakout. By that time it will be too late for stock, because if I were to see the broader markets, it is getting stronger day by day. Started with the auto sector, followed by auto ancillary, then FMCG, then metal stocks. Some of the hotel stocks performed very well and they have been doing well. And now I can see some railway stocks building strength on the charts. So gradually, many stocks have started performing. Momentum is started building up in many of the stocks. So broader market is performing well. If stock pickers in the mid cap and broader market segment wait for the breakout of 25,000, it will be late also, because no doubt about 25,000 there is a breakout in the Nifty, but broader markets are throwing a lot of opportunities for the traders to trade in. So I would suggest that one should remain with a positive bias. One can trade in the market, and stocks and sectors which are performing well we can trade, and there are a lot of opportunities are there. So 25,000 above which we can get a fully bullish breakout setup in the Nifty. Bank Nifty level is 54,500, above which we will get a breakout. But I think one can look at the stocks which are giving a lot of opportunities to generate the alpha in the short term. So yes, there are stocks which looks very strong to me. One of the sector and segment which is fresh breakout on the chart is the railway space. So RVNL looking good around 334. Stop loss can be kept at 325. On the upside, I'm expecting a target of 350 in next 3-4 session. The second pick I would take from the outperformer sector, which is auto, and that is commercial vehicle segment, Ashok Leyland. So Ashok Leyland around 135, 136, one can go long. 132 should be the stop loss, and on the upside I'm expecting a target of 140 to 141. So overall this space is likely to do well, and stock specific there are many opportunities which can be traded with the appropriate stop losses.
Okay. All right. Thank you very much for that. We'll keep those levels in mind as well for the index. Need to take a quick break. Come back on the other side. We'll have Manisha Gupta joining in with a roundup of all the commodity market action and a couple of the key stocks which are hitting the headlines this Monday morning. Welcome back. So the equity market is having a fine Monday morning. No problems there. Let's figure out what's happening in commodities. Manisha is joining in. Manisha, what's the latest?
Well, it's a kind of a morning where you have everything trading on a higher side. So you have gold near all-time highs, silver at 14-year highs, crude oil prices taking higher, coffee, rubber, everything is firm. But I want to focus on the global food prices. And there's an FAO report which has come out with the global food price index for the month of August, the prices here are at a 2-year highs. So when you look at a month-on-month jump, it's not so much. But on the yearly basis, we are up by 7% as compared to August in 2024. So strong commodity prices is what we are working with in here as well. So the prices are highest since Feb 2023. And the major of gains really seem to be coming in case of sugar and edible oils. This is where the inflation really seems to be catching up in the international markets there. I'll start with vegetable oils because here you have the highest inflation, 1.4%. The vegetable oil index is trading at the highest in 3 years as well. Now, there is gain in case of palm and sunflower oil prices, and that is because of the biodiesel mandate that Indonesia really seems to be putting with. It started with B30 and B40 and is talking about B50 as well in sense of blending in the next year. That is where sun and palm get their support from. It also has to do with the maize prices, which also are trading on a higher side because of the US feed and ethanol demand. So everything which seems to be getting divided in sense of food, feed and fuel is trading on the higher side right now. And then it also has to be with the meat price index, where you have seen 0.5% of gain, trading at a record highs in the global markets there as well. Sugar prices gained up too after 5 months of constant declines because of higher production expectations in Brazil and India. You have seen sugar gain up on the index as well. What has seen a decline, though, within the food price index has been cereals. This is down for a 5th month and down nearly 0.8% on a month-on-month basis. The other is wheat, a big decliner really, because we're looking at a very big harvest in European Union, in Russia. Indian wheat crop also expected to be strong. And then it is about rice, where India is the largest producer exporter as well. And with Indian prices of rice trading at a 3-year lows, that is impacting the international food price index also. Another thing that what the FAO has done is it has come out with the global cereal production as well. They're looking at 2025 gaining by 3.5%. And now this is a new record highs that we're looking at. Maize has surged up by nearly 6%. Not so much in case of wheat, but you have seen rice, which also is looking at higher production. So when you look at wheat, cereal, maize, rice, higher production numbers in the global markets are keeping these prices under check.
All right, Manisha, thank you very much for that. That's commodities with food grain, cereals, etc. under the microscope there. Manisha, thank you for that. Well, let's talk about real estate. Suntec is in focus and Max is the other one which is in focus as well. Ria is going to put the spotlight on these two names once again. Ria, over to you.
Well, yes, both of these stocks are in focus today. First up, looking at Suntec Realty. They have issued 1.17 crore warrants convertible into equity shares, aggregating to about rupees 500 crores. The issue price for this is rupees 425 per share, and this will be allotted to the promoter and the promoter group, who are going to subscribe around 66.5% of the total issue. Other investors for this include NT Asian Fund, Utpal Seth, as well as Mukul Agarwal. The next one is Max Estates. They have secured the development rights on a 7.25-acre land parcel. The group housing development potential for this is 1.3 million square feet with a GDV potential of over rupees 3,000 crores. And the outlay associated towards the transaction is expected to be around rupees 534 crores. So both of these stocks are performing well in today's session, trading higher by around 3 to 3.5%.
All right, Ria, thank you very much for that. So those are real estate companies in focus. We're going to take a quick commercial break here. We're going to come back with a very special conversation. My colleague Lata will be speaking with KVS Manian, the Federal Bank CEO, on the outlook for the bank. That's coming up in just a quick bit.
Welcome back. Post the GST cuts, we saw NBFC stocks like Bajaj Finance run up on hopes there will be more consumption and more consumption loans. Logically, banks should also benefit from such a consumption growth, but banking stocks did not react immediately after the news. To assess the outlook after the bunch of government steps to spur consumption, I have with me an ace banker, Managing Director and CEO of Federal Bank, Mr. KVS Manian. Good morning, Mr. Manian, and thank you very much for coming to our studio. It's still only 2 days after Onam, so happy Onam to you as well.
Thank you, same to you.
Well, let's start with this GST rate cuts. Do you see consumption getting a boost?
So I do hope that the consumption gets a boost, though of course there will be some hold on to the demand for this month, I guess, most part of this month. but hopefully from the next quarter, we'll see some impact in demand. The way I look at it is this is good from demand perspective. Interest rate perspective, I am not yet sure where it goes.
Yeah, I'll come to that, cost of deposits and interest rate cuts. But just to finish the growth argument, you know, your best performing sectors were commercial banking and CVs. Those were the two pillars in the just ended quarter.
Right.
Would you expect that CVs will do well simply because the cuts have come?
Yeah, so CVs, it's good for CVs, that is one. But Lata, the way I look at it is we are still a small player in CVs, so we should do well irrespective.
Okay. Oh, irrespective.
Yes.
And what about commercial banking? Do you think that the consumption can spur more? From commercial banking are still large SMEs.
Yes.
Or MSMEs.
Yes. So, I am more, if you see our last quarter also, we have put more emphasis on the commercial banking, and the small business have still grown slightly lesser than that. Because we are feeling more confident about the large SMEs. The tariff impact on small SMEs, we are kind of wanting to assess that, what the implications of those will be. And as you know, many people in the industry have called out, though our book is not showing any signs of stress. Many people have called out stress in the
Finance Minister has promised
SME.
a package.
Yes. So
she spoke to our channel.
Yes. So I am hoping that that part also picks up. But commercial side, the larger SMEs, I think we are very confident. Our book is very good, and we want to continue to grow that book.
Okay, so let's come to a number. How do you expect credit growth for the full year, for this quarter, for next quarter? Any numbers you can give us?
So, Lata, we've been guiding that we will grow at 1.2 to 1.4 times the nominal GDP growth. Of course, nominal GDP has taken a hit just now, but I'm assuming that through the next 2 quarters, it will normalize a bit. So, we continue to keep that guidance as
1.1 to 1.2.
1.2 to 1.4. If the credit growth is muted, we'll probably operate at the lower end of this. Otherwise, we'll operate at the higher end.
Okay, now let me come to the cost of funds. Have you all seen a fall?
Yes, of course. Of course, we have seen a fall. As you know, we dropped our savings rate also and term deposit rates as well. And we have continued to grow our deposits in spite of that. So we have seen a drop in funds, cost of funds. Last quarter, if you looked at our numbers, our cost of funds dropped by more than 18 bips.
So did the NIMs.
So did the NIMs. Of course, NIMs, as you know, are dependent on, nowadays, most banks have 40 to 50% of their book in the repo linked assets, and it's a natural drop.
Loan.
So we are hoping that the fall in cost of funds continues because the deposits will continue to reprice till May. Okay. So we think it'll...
another just near-term number. If there is no rate cut, what are your NIMs likely to be now and by the end of the year? If there is another cut, which can happen because of the CPI fall, then what are your impact on the NIMs now and end of the year?
Right. Again, Lata, we have guided that up. Post our last quarter, we said that we are close to the bottom of our NIM and ROA trajectory. Because if you know, we reprice T+1 basis. The day repo drops, we reprice it on the same day. There are banks that go up to 90 days on that. So we've taken large part of the fall already. And therefore, we think we are close to the bottom. We had guided that not less than 5 to 10 basis on the NIM side.
So 2.94 can become 2.85, not lower than that.
Yeah, not more than that. I mean, hopefully
but when does the U come?
So I think we should see uptick from here on.
Second quarter itself?
Second quarter, like I said, there may be small impact. But after that, the next 2 quarters of the year, we should see an uptick.
Okay.
On both ROA and...
So your year-end NIM could be over 3?
Yes, of course. Yes.
Okay.
Surely.
Okay. So now let me come to the MFI issue, which obviously showed up in higher slippages for you, higher credit cost.
Yes.
What's the sense?
So, as you know, if you saw our last quarter, there are 2 things I want to talk about. One is the increased credit cost we took was primarily because of MFI. If you looked at the slippages of all the other non-MFI assets, they were exactly where they were 1 year back. Our slippage was 0.77%, sans the MFI thing. It remained exactly the same 1 year later, 0.77 to the second decimal.
Okay.
So the primary increase in credit cost came out of the MFI business, where we feel the peak has already happened. May was our peak month. We have seen drop in slippages since May, June, July both. August we have not gone public with the data, but June, July we have seen a drop, and we think we are past the peak on that.
Okay.
And we've also guided that in spite of the fact that we took a 65 basis credit cost in the first quarter, our annual guidance on credit cost remains 55 bips. Okay. So we have not changed our guidance.
You expect the provisioning to come down?
Yes.
I mean, loan loss provisions to come down.
Yes.
What about MFI? I mean, we just had a note from CRIF. They were a little, MFI, MSME and SME.
Right.
They were a little worried. They are seeing trouble. So do you think MFI goes down, but business banking, for instance, can show more...
So like I briefly mentioned earlier, we aren't seeing any stress in our SME portfolio, business banking portfolio.
Okay.
But having said that, it is an area that I want to tread cautiously for sure, because like I said, people have called out stress, and there are small SMEs which can have impact due to tariffs, and hopefully the package that the government is talking about happens, then it will give us comfort. But just now I remain cautious, but I'm still optimistic. It's not that we don't want to grow that book. We want to grow that book, but we will be relatively more cautious at the lower end of SMEs than at the upper end of the SMEs.
Okay. So overall, what is the ROE guidance now? Now, after the new developments in tax cuts, new developments in tariffs, what is the ROA guidance?
So, like I said, we have probably seen the bottom of our ROA journey just now in this rate cycle. Of course, subject to no more new rate cuts. I think we should see an uptick from here.
Okay. No, I'll tell you why. Because this quarter, you all are not going to get other income. Your last quarter for all the banks, although net interest income fell, this other income component, because of the rise in bonds, helped.
Yes.
But this time there will be bond book losses.
Yeah. So, Lata, if you looked at our last quarter, our pure fee-based income also grew by more than 20%, 21% actually.
Yeah.
So we are also growing our fee income strongly. So yes, you are right that on the prop side, there may be some impact of the higher interest rates. But, you know, these higher interest rates, as you know, this has been range bound, right? 20 bips here, there, and you don't know when it retraces back, the interest rates retrace back. If the next CPI call is lower, you never know the interest rates.
The CPI call is going to be lower. So I think bankers have to be prepared for a larger possibility of another cut. I mean, we can't read the RBI.
Right.
But if most economists are pricing in a cut, therefore, what is the ROA trajectory?
So the further cut will impact ROAs. There is no question about that. Again, we should be clear that will be the case. Having said that, you know, there are 2-3 things we are doing. One is, if you see our dependence on floating rate assets is going down. 1 year back, 53% of our assets used to be floating rate. Today, they are 48%. Okay. So we are also, reducing that. Okay. So these should help us, mitigate the impact of falling interest rates. Of course, we are also trying to change the mix of our liability side into more CASA, which also you have seen last quarter, the results have been good on that.
Oh, yes.
So I would say mix of things. There will be things we will do to defend the drop, but there will be some impact, of course. And if you noticed our last quarter results again, the drop in NIM that we reported was significantly lower than most analysts expected, right? Because of all these cost of fund drop and the mix change on the asset side, all of that is also playing out. Okay. So we'll continue to do our best on all of that.
Okay. Anything we should know about your subsidiaries? the NBFC or the insurance? Any other activities that you are planning?
On the insurance side, as you know, we have an approval to take our stake from 26 to 30%. We are in the process. Yeah. So we have both the approvals in place now. RBI as well as IRD approval is in place. So we are in the process of executing that transaction. So we'll take our stake to 30%.
And on FedBank Financial Services?
On FedBank Financial Services, it is status quo. Nothing, no plans.
And no capital raising either?
No capital raise either.
Okay. No, I mean, even for federal?
Even for federal, not just now.
Not just now, as in how long will your capital last?
No, so I think we are at 16% capital adequacy just now. So I think we are okay. Something like a year we can do without capital raise.
With this kind of growth, yes. Okay, and finally, you gave us a 2028 ROA goal.
Right.
You want to refresh it?
Yeah, no, so...
that was the 2% goal.
It is not exactly 2, but ROA 2 is a bit high. But I would say 1.5 kind of an ROA is what we want to aim for in the next 2 to 3 years. And that's what we said in our February analyst presentation. And that's the direction we are moving in. Of course, the number is important. But, it depends on the macro, what the overall industry ROAs look like and all that. But, yeah, we are directionally headed towards 1.5 and 14-15% ROE, 1.4, 1.5.
We do hope by 28, a lot of the tariff uncertainties at least will settle down.
Yes.
And our growth path will be far more clearer.
Yes.
Thank you very much.
Thank you,
Manian, for
Pleasure
dropping
being
into
here.
the studio and for chatting with us.
Thank you so much. Pleasure being here. Thank you for having me.
Well, we have to wrap up on Bazaar on that note. Chartbusters coming up after the break.